let me just quickly, you know what? I'm going to dispense with my monologue. We'll get to it later. I was just going on a rant about how, trying to call the market on a day-to-day or week-to-week basis is a fool's errand. I try not to do it. And that people are always trying to ascribe meaning to daily movements. And, what's often more, oftentimes, as Stan Weinstein would say, it's not the news that counts, but it's the reaction to the news that's important. And if people try to start saying, well, because the market was up yesterday in response to what the Fed said or didn't say, therefore the coast is clear, all good, not so fast. So, again, I try not to get caught up in the day to day and week to week jiggles. Instead, try to look out a little bit further. And my view hasn't changed. We've been in this period where, the first half of the year, market got destroyed, valuations compressed in response to rising interest rates. The second half of the bear market, as Michael Kantrowitz has been calling out, and Ian Harnett, is going to be less about valuation compression and more about earnings falling apart. I agree with that view. That's my view. So we're in this awkward transition phase right now. Anything's possible in the short run. I don't really think anything has changed. I think the idea that inflation is going to come down to the 2% target the Fed wants by next year, even if inflation is peaked, but the idea that it's going to get to 2% with wage inflation at 5% and accelerating and still a record number of job occupancies as opposed to people looking for jobs, to me, it's very fanciful. So enjoy the rally while it lasts. We'll take it from there. So in any event, I'm sorry I kind of rambled. I didn't realize I had the mute button on. So I don't want to waste any more people's time. We're here today to listen to our great speaker, Danny Moses. Danny's very well known to most of you. Requires very little introduction. There's not much I can say. He's had a wealth of experiences. There's a lot we can talk about, whether how he got started in his career, The Big Short, various good trades he's made in the past, how he views markets now. But we can get to all that in the course of the hour. But I think to just kick it off, Danny, where I'd like to start is, there are a lot of moving parts in the market right now. Opinions are like noses. Everyone has one. I could employ a more crude rendition of that, but I won't. Let's start off, Danny. So as you look at markets, what occurs to you? What sort of compels you? What do you have high conviction on? It may not be the market itself, the market's collection of stocks. It may be a group. It may be a theme, a sector, whatever. But what's sort of top of mind for you? What are you most passionate about? What are your most strongly held views right now? Welcome, Danny. We're very, very nice to have you here today.
Yeah, George, thanks for having me on. And, I think for the first time in a long time, what's really hit me is how good things were for so long as a consumer, as an investor. If you were long, obviously, not if you try to fight the tape like me. But I'm saying just in general, market conditions, consumer conditions, and you start to realize that this reversion to the mean is going to be painful in many categories, not just in the markets, but just in life in general and purchasing power and things like that. So I think back to the global financial crisis or great financial crisis, great recession, whatever you want to call it, in 2006, 7, 8, 9, and all the programs that the Fed obviously brought in and Treasury brought in and all those things that kind of masked, I think, what we're seeing now. And what I mean by that is there hasn't been price discovery in bonds or equities for quite some time. The advent of passive investing obviously has created a massive correlation to all things equities and all things bonds. Passive investing in fixed income, as a matter of fact, has grown to crazy levels as well. So I think we're burning back through the atmosphere here and starting to do bottom-up work in credit and equities, and that comes at a cost. So I think the haves and the have-nots in both of those worlds will continue to separate themselves, and I think that's a lost art. And I think George, you and I have seen many cycles, obviously, and this is unlike anything we've seen. So to even try to predict what this is going to be like is a fool's errand. You'll have fits and starts of the point you made at the opening of markets can rally for a period of days and the chase goes on, but the backdrop of it is this, and I'll turn it back over to you, is that we just saw 2 negative quarters of GDP, right? I don't care what definition of recession is, whatever. While unemployment is still effectively at an all-time low. Unemployment only has one direction to go here, And the layoffs have really started, the announcements of the layoffs have started in earnest in the last 3 to 4 weeks. So all the stuff you're looking is backwards looking. What the Fed has done, and now they're back to the levels of kind of the last rate cycle 3 or 4 years ago, where we are, we haven't seen anything yet. But one thing is clear that the bond market is telling us. The bond market is telling us that the economy is going to slow. The inversion is obviously giving us all the signals that we need on the 210 and 2.3, 2.5. However you want to look at the entire curve is flat now or inverted. And that's what I'm watching. And I'm watching that the Fed now, who's been wrong for, I'm not going to rant on the Fed here, but has been wrong for several years in not addressing what was coming as far as inflation, is now overshooting to the opposite side. And I just can't understand why, this need to get to 2% so quickly. Again, I'm not saying that they shouldn't raise rates. I'm saying that they should. But the logic that didn't exist when they didn't raise rates is now the same logic when they're raising rates. And the reason I say that is the comment that Powell made yesterday about, listen, this meeting to the September meeting is the longest duration that we're going to have. And I think the bulls took from that as if, great, well, we're going to see a lot of economic data that's going to show that things are slowing. It's going to be right in the Fed's face. Gasoline prices are dropping. So the things that we know about, inflation has probably peaked. The problem with that is, and I promise I'll turn it back to you at this point, is if that's true and the economy is slowing like this, earnings are still too high. And Mike Wilson always says, and I think he's great. I think he's nailed a lot of this stuff is you never buy the first cut to earnings. I mean, we are cutting earnings now. It's just starting. So I think there's going to be a massive reset. I think risk premium is going to get reset. I think, so I think we are seeing a market that no one has ever seen before. And all we can do is to try to have as many tools or as many signals to watch. But I will say, you can own the market. This is not a bear rant at all, but you need to own quality, and it can't just be for a day or a week or a month or a quarter. I think you need to really understand what you own, and that goes for equities and bonds. So I'll stop there. I'll turn it back over to you. But we're in the middle of an experiment here, and it's not fun being the rat, for sure. So
really well said, Danny.
Yeah.
So I was listening to Jim Bianco this morning, and I urge everyone to follow Jim. He's great. He's been in this room a bunch of times, and he pointed out some of the wordsmithing that's going on the part of the Fed is just false. There's this attempt to try to recast what a recession is, and we're having a technical recession. It's not really a recession. It kind of makes you feel like when you're watching an NBA game, Danny, and there's a foul and one team protested. We got to look at the video replay. Go to Secaucus, New Jersey. Did the guy have his foot on the line or not? And then we'll decide whether or not it really was a recession or not. And Jim calls BS on that. The administration wants to point to the fact that because jobs are still, we have positive jobs, positive payrolls, that it's not a recession. Well, bollocks, as our British friends would say. And he actually goes back. Facts are stubborn things, and I haven't bothered to do the work, but he has. I presume he's correct. He points out that in 70, 71, 74, 75, 79, 80, all three of those cases, for varying duration of time, you had jobs continuing to increase despite the fact the economy was already in a recession. So I just say no to the nonsense coming out of Janet Yellen's mouth and Joe Biden's mouth. I don't mean to make it political. I'm just talking about facts. So I think it's quite possible, if not likely, that we are in a recession. I mean, that 2 quarters negative growth, whatever. But rather than getting into a semantics, Danny, about we're in a recession or not a recession, the question is, how do we make money and what moves asset prices? And so I think you were spot on. Mike Wilson's one of my faves also. And he points to never buy, the first cuts. And we go look at earnings. One of the things that I'm really amped up about is I think earnings are going to be a disaster. And it's not, and I don't mean it necessarily in terms of depth of decline. There's an interesting note. I put it from the Fed guy, Fed guy 12. And we're going to have him in this room sometime next couple of weeks. So,
Joseph.
Joseph. Yeah, exactly. And
I just read his piece.
And he's talking about how, you're not going to get that much in the way of job losses, and therefore, companies. And there was another great Miss Shedlock had a similar piece a week or two ago, which I put in my feed. And I want to know what you make of this argument. Today. He's talking about how since the labor market's tight, McDonald's, they talk about 10% wage increases is what they're seeing. The companies really aren't going to shed that much labor, and therefore, all things being equal, that's one of the levers you pull when you want to, protect your bottom line. And I'm just kind of wondering, what do you make of the idea that this could either be that this might be and again with two guys spitballing, that this may be a sort of long, drawn out, protracted affair. It doesn't have to be deep. Maybe it's shallow, but that it could be long and drawn out. And the element of time, one thing that strikes me, I'm sorry I'm talking too much, I'm not being coherent, I need more caffeine. But one feature of this market pisses me off. I'm sure you probably noted the same. It's like, because the Feds have this policy of always running to the rescue with more liquidity, we never have a proper bear market. It gets a correction and boom, they fix it, right? But would really screw up everybody if we have this sort of long, drawn out, shallow type of slow economic environment, recession, no recession. Earnings just don't go anywhere. They go flat to down for a long period of time. And because inflation remains higher than it has historically, they can't come to the rescue with a lot of liquidity. So again, the fact that everyone's bared up doesn't tell you anything. Sentiment is, as John Carl was saying, Tom Thornton was saying the other day, it's a condition. It's not a trigger. But what would you think about if we just had something? And you said this experiment we've never seen before. What about the idea we just get a sort of long, drawn out affair where earnings are flat to down, and you get no multiple expansion. In fact, you get contraction, and you get a sort of sandpaper death by 1,000 cuts market. What would you say to that, Danny?
I was just about to say death by 1,000 cuts. You took the words out of my mouth, and I actually just think, I think there's something really, really interesting here. Is that what makes bulls want to go back into the market is if the Fed has their pivot moment. But what would make the Fed have their pivot moment is just continuously declining economic indicators, whether it's unemployment growth, GDP, whatever it may be, retail sales. And so those don't jive, because that means that the market has yet to price in those things into your point about, whether it's price earnings multiples, however you want to look at it. So we're just at the beginning stages of that at the same time. So again, unwinding not just the Fed tightening here, but unwinding the balance sheet through quantitative tightening is already having massive reverberations in the housing market. We've seen that, within the mortgage market. And I'll just tell people, the biggest clue that Steve Porter-Vinny and myself found in 2004 and 5 and 6 was to watch the bond market. But it just is what it is. Fixed income investors are smarter than equity investors. That just will always be. There's much more quantitative work that goes in for the most part, the people that are actually doing the work. And I watch those markets that tell me exactly what is going to happen. And the bond market is telling us the Fed is overshooting. They're currently overshooting, right? And that the economy does not have the ability to function in a high rate environment because the amount of debt, both a government level and private level, is too large. And so that in and of itself, George, slows the economy, because the companies that need to come back to market to finance their business, if they can even get the money, if it's a worthy business, they're going to get it at a higher rate. And the ones that only existed because either the Fed was literally buying their debt on the balance sheet or printing are going to go by the wayside. And that is the lab experiment that I'm most fearful of. And if you look at what mortgage rates did or have done, even before the Fed started quantitative tightening, does not take a genius to figure out that the dealers in the marketplace, or people that own mortgage-backed securities, that those would widen out much quicker, much faster than treasuries were rising. Because just not having Big Brother at your back to watch it, it already is happening. And so the most asinine thing that I think Waller said, or someone at the Fed said, I think Powell has commented, is they believe, with putting a finger in the air, that quantitative tightening is the equivalent to a quarter or half of a point of a raise. So yesterday, to me, when the Fed was relieved to just get 75 basis points over with, I think we've seen there will not be another 75 basis point thing that's going to occur. I'm even possible that we're not going to see anything anymore. I'm not going to go out on a limb, but maybe another 25, maybe 50, because the indicator. So what is that good? No, because the reason that they would shift like that is because, and so I guess what I'm saying is trying to match where earnings are going versus the Fed pivot, and what signal does that send? To me, that's not a reason to go buy the market. That's a reason to actually be more scared about the market. But the point you made, and I'll turn it back to you here, is that people need to own something. So you can own certain things, certainly, solid consumer staple companies, names that are defensive by nature, have a dividend yield higher than treasuries and so forth. So there are things that you can own. And gold, we can talk about that at some point, which I, truly love here. But again, there's always some to own. And I just, that's kind of just a takeoff of the point that you made, but death by 1,000 cuts. And that's why it's going to feel, you just can't unwind 13 to 14 years of nonstop liquidity and just turn off the faucet and think that everything's going to be okay.
That's awesome. So let's just go deeper in that. So Michael Kantrowitz, I hope he comes in the room today. He is always the smartest guy in the room when he's here. When you get into this question about value versus growth, he instead slices that, he deals out the cards a different way. He says, no, don't get into this, value growth arguments, or really more about quality and non-quality. So on the one hand, yes, of course, you don't want to own the super long duration, loss making garbage that Kathy Wood owns on the one hand. But on the other hand, you also don't want to own the living dead, the zombie American Airlines, levered balance sheet, high operating leverage, very cyclical at the other. So you don't want to be in either end zone. To use the football analogy, you want to stay in the middle of the field between like the 30-yard lines. You want to own sort of quality growth and quality value, however you want to define that. So it's more about companies that are cash flow positive, good balance sheets, that don't depend on the kindness of strangers, i.e., external financing. And you turn off the liquidity taps. I mean, we'll find, as Warren Buffett says, well, when the tide goes out, we'll find out who's skinny dipping. So, what would you make of? I gather, am I right to infer that this sort of quality versus garbage argument, that you would have sympathy for that?
Yeah, for sure. And I think the one thing that upsets me most, and I know that you try to do a great job just educating investors, is that, I'm still seeing, call them meme stocks, call them whatever you want, but just garbage companies that just trade on either news events that are meaningless to the fundamentals, but the kind of, FOMO trade that people feel like they have to get out. And it's painful to watch these, just Bed Bath and Beyond, the GameStop and AMC and Tesla, which we can certainly dive into at some point. That's its own animal. But to watch that occur, and what the end game is going to be. You mentioned ARK Asset, Kathy Wood, and we know what the end game is going to be. Teladoc today, et cetera. So that part of it is the most damaging part. And that's the part that's a piece of kind of 1999, 2000, 2001. You can't buy garbage here. So, and there is no quick fix. There is no quick, could you make money on a day trade and an AMC on a box office release on a weekend? Sure. But we all know the terminal value of some of these companies, to the point you just made about owning quality. And so to me, that's where I know we're not near the bottom, because I'm still seeing those things occur. And as soon as that wipeout occurs and those stocks go to complete orphan status, single digit, gone for, then I know that we're getting much, much closer to capitulation. And so I fear, and August has always been a bad month when there's been a reason to have a bad cycle, whether it's 2011, I think 2015, whatever. I think this August is setting up for that exact thing. And so to me, you can, Fed noise aside and all the things that are going on, at the end of the day, stocks are going to find their appropriate levels, whether it's a death by 1,000 cuts and it takes a year or two, or whether it happens rather quickly. And I'm, again, I don't want to be overly bearish here, but I want the reset to occur quicker. I don't want this slow moving. I kind of want the capitulation to occur. And I think everyone does. Let's just get to where we're going to go. And then you can pick up the pieces. And those meme stocks and things like that will not be what you want to own. And it's created so much wealth destruction for people on a relative basis, chasing at the top, selling back at the low, even knowing, following people like Ryan Cohen and Adam Aaron, and even if they have good intentions, like, there's no corporate governance. Now I'm going off on a tangent. The lack of corporate governance that exists in these various places, and I can blame the SEC, I can blame the boards of these companies, but I blame the investors, because do your work, know what you own. Look at these. No one's going to read an annual report, but my point is that call bullshit when you see it, and don't fall prey to chasing. So sorry to rant.
No, Danny, that's great. Danny, I couldn't agree with you more. What do you make of the fact that the investing public, they put in what was over $1 trillion into the market last year? They've hardly taken any money out this year. What do you make of the fact that in the face of this incredible decline, they haven't sold anything yet? Because I still look at, I step back and I say, you know what, this is not going to be over till these guys puke. You got any thoughts about that?
Yeah, it is incredible that money is still kind of flowing in. I think people don't like to look at their accounts when they're going down. They don't like to open the account. Obviously, and they get, quote, monthly statements, is what we used to term back in the day, that would kind of cause some of these moves. I'm not sure exactly why the hope trade, listen, people should stay invested if they're long-term investors in the market. You want to own the S&P, don't try to trade around it. But to your point, I don't know if the amount of people that own passive and they feel safe because they own a large ETF but again, I don't think they understand that there's massive correlation which is occurring when 5 or 6 stocks are controlling 50 to 60%, right, of all the moves that are occurring. It's just not a healthy environment. So that's why you just pointed, George, and I'll make the comment that I just had. That's why we're nowhere near capitulation. That's why we're nowhere near the bottom. You want to see those people start to sell. That's what you want to see, and we're just not. And so whether it's a factor of they don't need the money yet and they're not tapping into it. I will say one thing which I want to mention is that personally, people that have lines of credit, whether I don't know if it's tied to a home equity line, if a life insurance policy, wherever it may be, and corporations that have it for the first time in this entire cycle, for the first time in 13 years, if you read the fine print with the asterisk on credit card, et cetera, everything is now exceeding that threshold. So for the first time ever, if you were paying a flat fee of 3% on a line of credit, you were always kind of below that. Last month, for the first time ever, statements went out, or they saw, hold on a second, why is my interest on a $200,000 loan at 3% change so much? And now, after what the Fed did yesterday, that 3 is north of 4. And so these are the things that are happening slowly. I think that all kind of come together on the consumer and that will start to have an impact. And that's why, on top of goods being more expensive, financing is becoming more expensive on the corporate and consumer side of things. These are all kind of blending together. And so I don't know what it's going to take, but it feels like there's something coming, George, because to your point, we haven't reached the bottom until we start to see those type of outflows.
So Danny, rumor has it you know something about housing. And I can imagine it's not the focal point of what you do, but I'm just curious. We had Ivy Zellman in here the other week, and
Huge Ivy fan.
Yeah, she's the best, and we had I think over 30,000 people listening to her. She just blew people out of the water. It was unreal. And what really struck me was my couple takeaways were: one, the speed with which the market is changing, and she was talking about how whether it's because of the internet and you got Zillow and Redfin and all this stuff, people are more in tune with what's going on. But even more important than that, 24%. 24% of transactions are non-primary now. So whether it's Blackstone, buying houses, or it's build to rent, or it's everyone is becoming a hotelier. Everyone wants to do an Airbnb. Don't worry, I'll buy it and use it as an Airbnb. The point of all that being is a 24% being non-primary. That when the market turns down, that potentially represents hidden supply. And we know history doesn't repeat itself, but it rhymes. And so, yes, we do not have the excesses, I don't believe, that we had in 2008 with respect to mortgage finance and mortgage-backed securities markets. But we've got this other issue. And so I'm just kind of curious, I want to put that out there. As you look at housing and recognizing the prominent position that plays in the economy, it may only be 5% of the economy, but the multiplier effect makes it a huge driver of growth. Is there anything noteworthy to your mind when you look at the housing market?
Yeah, you don't have as many of the exotic products that obviously caused a lot of the issues, 13, 14 years ago. Most people are locked into fixed rate, not variable, although that's changing. So those type of things aren't the same. We had a supply problem. Now we're going to have a demand problem, right, on that side. So you have two choices on what we call cap rates, I guess, for an investment property, if that's how you kind of want to look at this housing, right? You can, what percentage of the rent you're getting relative to the value of the entire property. That's how you calculate your cap rate. With rates moving higher and investors requiring a higher rate of return, you have two choices. You can either raise the rent, right, or the value of property goes lower. One of the two things is going to happen. So whether that's sitting on a balance sheet of companies that are out there that are buying these homes up and renting them out, or whether that happens on the builder's balance sheet, or wherever that may happen, we only have one direction to go. And housing, I know Bill Pulte is on this call. I see him up on the top right here. Certainly, having talked to Bill over the years, and he completely understands this dynamic. It did not take a lot of what the Fed has done just to create this kind of slowdown in housing. It was rather quick, and the builders themselves got hit on all, right? They got hit with inflation in terms of their cost of materials and so forth. And now, I think we've gotten through. I think it's safe to say that we've seen the top in housing. So what that's going to cause or what that looks like on the back end, I don't think it's as damaging as what we once saw, but certainly it's a leading and a huge component of the economy. Things are still tied to housing in many different areas. So the answer is I'm watching it. I don't think it's cataclysmic, but it is a signal to me, a huge key for the slowdown in the economy, because those things always tend to get hit first. And again, builders may be the best buy in the market when this is all over. So, when it's all said and done, they were the first sector that was trading rationally. This sector was starting to get hit, 6-7 months ago. It was already telling you what was going to be happening. So builders are always, I think, the most cyclically impacted sector when it comes to the economy. So,
right. Danny, let's move it around here a little bit. I know you have views on. But by the way, I urge everyone to listen to Danny's. You can find him on YouTube. Did a great interview with my friend Michael Guide about a month ago, so it's quite informative. So listen to Danny. I know you have some views on crypto and on gold. Do you want to speak to either of those?
Well, crypto, I was never, again, I missed the whole trade obviously on the way up, so you shouldn't listen to me on the way down. But obviously, all these coin offerings and tokens and things that were occurring, I knew, I think any person with a brain that's been in the markets long enough knew that that was just a flash in the pan. I think it's self-fulfilling that Ethereum obviously is here to stay in the sense of the applications that are being created from it. There's too many smart people that are involved to not have something. Bitcoin, is a whole nother issue to me. I don't believe in it, but that's being said, it's this whole argument that it's tested for inflation. It's kind of horseshit, because in one way you want regulation to protect people, but at the same time, the whole thesis of Bitcoin was that no government can touch it. So I'm kind of caught there. As it relates to gold, I've been saying for a while, yes, it doesn't have an interest rate on it. It doesn't provide any type of return monthly basis. But with what's going on in the world geopolitically, certainly if the Fed loses control, if you even think they have it in the first point, it's certainly a place to hide. And if there truly is a pivot occurring here, and the Fed has to indeed start cutting rates, whether late this year or early next year, I don't see how gold is not a massive beneficiary of it. And I don't think really anyone owns it. And so, again, I wouldn't call me a gold bug guy, but of a place that I feel that I can own, I'd rather own gold than cash at this point. So, I do like gold here. So,
fair enough. So you've been at this for a long while. You've got some. I don't know if you have gray hair. You probably have less gray hair than I do. But it's like when you're those dating sites. Danny, is that a current photo of you?
Yeah, no, I freeze that in time, make it 6 years old. So, by the way, I want to make a comment on Ivy Zellman. Just she was a huge part of everything that we did. I mean, we got so much information from her in 2005 and 6 and 7. There was nobody better. There was 5 or 6 key people that I think helped people like us along the way kind of navigate. I just wanted to make sure that I mentioned that. So
yeah, as long as you're saying it, that actually brings another question to mind. Having been at this for a long while, I think the quality of research has never been worse. Street research.
Yep.
I use Twitter all the time. I follow smart guys like you and a bunch of others. And so, do you use street research at all? And for the average guy in the room who's trying to figure this out for himself, not telling him what to buy or sell, not giving him picks, but it's the old line, give him a man a fish, you give him a meal, teach him how to fish, you give him a livelihood. Like, what would you say to the average person in the room that wants to make themselves a better investor? I mean, Twitter's really one of my main go-to research resources right now.
For sure.
I mean, do you use Twitter extensively? Do you follow right there?
Yeah. I follow. Yeah, find them. I find new person every day. Wall Street research has never been worse. It's never been more complicit with banking. I mean, I thought we got through this in the Frank Quattrone era, Blodgett era, but it's never been kind of more connected. And nobody is really there's no self-check process. If you just look at the percentage of buy ratings and sell ratings on the street, I like to use it for counter arguments. If I'm long something, I want to find a sell rating, which is hard to find on something. And if I'm short something, I want to find what the long thesis is so that I can get, in front of it. But let's not kid ourselves. It's never been more choreographed in the history of my career than what I've seen out there. So use them how you want, but obviously read every report with grain of salt. And I would be cynical. And it's not just about the banking fees and trading fees that people are receiving. The history on Wall Street has always been, if you're short and you're wrong, you're going to get fired. if you're long and you're wrong, you'll still have a job, right? Because nobody likes the person that calls sky is falling and then is proven wrong over a long period of time. Because if you're right, by the way, you're probably not going to get paid eventually because your firm's out of business or your business dropped. And if you're wrong, it doesn't pay to have sell ratings on the street. It just doesn't. It's just not how it is geared. And so the answer is I use everything I can, and I assume everyone's lying. So
I know someone. I know someone in this room who would really agree with you, and it's our friend Marc Cohodes. Maybe we'll get Marc up here to kind of weigh in a little bit on this.
Oh, great!
Get another old guy in here to talk about this.
Exactly.
So you know what? I can keep firing questions at you, but let's mix it up a little bit. So I want to bring some of the others into the conversation. By the way, if you have a question and you're requesting to be heard, and I don't know who you are and I haven't brought you up, please send me a direct message. I'm trying to keep the conversation on track, and if I don't know you, I need to know what your question is ahead of time. All right, so let's first go to Basement. Hey, Basement, the floor is yours. What's up?
Hey, George. Hey, thanks for having these spaces. And anybody that's listening that is not familiar with Danny's podcast he does with Danny Nathan and Guy Adami on the tape, it's a must listen. Really appreciate it. Question for you, Danny. Back during the housing crisis, when you guys put the trade on and bought the CDO swaps, and the rating agencies held, and the banks kept talking their book, and the trade wasn't moving like you wanted it to. I wonder if you could just kind of talk through what the internal conversations were, and maybe how that might be instructive to, what I think is the next massive fraud, which is Tesla, which I hope you guys will get to.
Oh yeah, I've heard of that one. Thanks for the shout out on the tape. So we actually were lucky. So Christian Bale's character, obviously, in the movie, obviously he was right for. He went early in 2004, and if that had happened to us, obviously, for a couple year period, we'd have probably gotten out of the trade before we ever got to experience. We got very lucky that from the minute that we put this trade on in August or July of 2006, it started to work. And while we were an equity fund at the time, we were kind of using, like I said before in this spaces, that the bond market gives you a lot of signals that were going on. It was extremely useful to watch what was happening in the fixed income, in the CDO and CDS market, to get an idea of what was happening in equities. And what was crazy about it was spreads were widening in fixed income, CDS was exploding, and yet the equities had yet to reflect it, whether it was a Citigroup, Countrywide, whatever it would be. It made no sense to us. So in the morning, I would speak to the fixed income desk before I would speak to the equity desk that would kind of gear us up to how we would look at how we would look going forward, either for that day, for that week. And so we got lucky. So I just want to be clear that from literally the day that we put it on, it started working. And that gave us obviously much more confidence to go even further into the trade. So again, we weren't all in. We had an equity book that we were watching at the same time, but we used it as a tool. So the things that we were watching, though, unfold in real time only gave us much more confidence. We kept adding to the trade, buying more credit protection, and so forth. Did we think that Lehman would go under at the time? No, I don't think we ever thought that could potentially occur. But we knew that there was vulnerabilities at all these banks, and the banks were, the banks were printing money as long as they could. The rating agencies were printing money as long as they could, and then the music stopped. And the government did not understand, and to be frank, neither did we, the spider web that existed within all the financial products around the world that were kind of out there at the time that really caused us. And so, I was not a fan of all the government programs that came in at the time in real time, because I'm a big believer in market clearing prices. But when you bring in the TARP and the TALF and the PPIP and all that stuff, coming into play, that kind of masked it at the same time and stopped the bleeding. I think we got lucky from the standpoint of we were able to actually get out of that trade, and that particular group of assets that existed were never impacted by the government. They never got to them, so to speak. So timing is everything. We got in it and it started working. And so, other firms obviously had this trade on. We weren't the only one that obviously was out there doing it. But so I just wanted to clear that up, that, it worked for us right away, and we used it as a great tool to navigate. So.
Yeah, I mean, I don't know if this is getting too far in the weeds, but I don't know if you parsed out like Tesla's latest quarter and the cash flow with Bitcoin and their warranty reserves and I mean their daily cash balance and on and on and on, and it just how that might just be instructive to what.
Sure. No, I was going to say, so, I mean, obviously I just posted a thread on that recently. I just kind of went through and took a step back, and I always like to read the cues and go through because I don't listen to it. I think everyone lies to you on all of these calls, and, specifically being on a Tesla call is like going to a concert versus, really going in and seeing what's really happening under the hood. So yes, there's no justification at all for an $800 billion valuation or a 7 or a 6 or a $500 billion valuation. So when a company doesn't trade on fundamentals, you got to be very careful. Certainly, if you want to short it on, if it doesn't trade on fundamentals, what is the catalyst to make the stock potentially go lower? And this has been a long time in the making, and obviously it's been a very painful short for many people watching this, and it's made me lose hope in the capital markets just in general, because obviously you want to believe that there's rational people. When I've said this now for a better part of a year. I'll know that the market's corrected when Tesla finally sells off, because to me it is everything that's wrong in the markets, right? It's got a horrible corporate governance, right? There's no board monitoring anything. There's massive SEC violations, whether it's 8Ks, however you want to, whatever you think is a disclosable event or not. You can't. Their financials are so masked in questions about what is your cash balance on a daily basis or quarterly basis, except for the day that you need to close your books and report, right? Where's the interest income, to your point you just made, off of that cash? Nothing really adds up. So how does it trade, and what does it trade on? I know that eventually this thing will crack. I don't know what it's going to be. I can't tell you what that catalyst is going to be. It's always something that you don't think of, but I'll rest my hat on always fundamentals playing out in the longer term. And so I can go on and on about accounts payable, accounts receivable, intercompany dealings, things like it just is what it is. And there's so many things going on. It's almost like a negative times a negative equals a positive. We are now immune, and it's not just Tesla. It's just in general to, things just occur, and you just get used to it. You're like, oh, well, I guess that's normal. Most CEOs would have been forced. Well, all CEOs would have been forced out of their role within a company if anyone acted like that. And it's certainly in a Fortune 500 or Fortune 10 company. The top 10 holding in the S&P. So you're going to get me going on a long tangent. I know that George probably doesn't want to turn this into a spaces about Tesla, but let's just say that I'm a big believer in bottom up, and at some point this thing will crack, and it may be something that none of us think about that causes it. But yeah.
Danny, I couldn't agree with you more. And let's just. I really don't want any more discussion about Tesla in this room, just because there's really nothing to discuss with respect to the fundamentals. If you're going to try to argue try to explain what the stock is doing, Marc Cohodes, who's going to speak next, has had the best, I think, site on this, which is wait till the jaguar falls out of the tree and the jaguar is still up in the tree. So let's just not go there. It's just not a productive use of our time. Thanks for the question, Baseman, but we're just warning everybody else in this room. We're not discussing Tesla anymore today. So now with that, we got a bunch of great questioners here in a row. We got Marc Cohodes, be followed by K-Fab, and then Mark Newman, and then always. Hey, Mark, good to see you. What's up, man? Mark, please unmute yourself.
Hey, George. Hey, Danny. We got the dream teams in here. We got Danny. We got Danny. We got Porter. We got Vinny. We got Carvana, man. We got the gangs all here. So the one thing that's in my head is, when do you think investors are going to start thinking about balance sheets with income statements? Because I was on the Overstock call this morning, and they had a horrible sales quarter, but they made money and they're generating cash. And I think they're just going to put an axe in the head of Wayfair, who has a horrible balance sheet, and Ryan Cohn's air-conditioned-less Bed Bath & Beyond. When do you think people start to look at balance sheets of some of these zombie companies? Because maybe in this cycle, I'm thinking they could go under. Just curious how you and you're looking at and thinking of this.
Yeah, listen, you have these non-GAAP, which are out there, the GAAP, which is out there, and you always look to see what is your free cash flow, and can your free cash flow cover your obligations? That's pretty simple, right? So that's how I look at it. I don't think anyone, you got to really shake the tree whether a company actually has a negative event, whether they actually report an earnings loss or whether they start to lay people off or guide down. That makes people take a fresh look at the balance sheet. And I've been saying all along, companies that you want to own here are the ones with the good balance sheets, the ones that aren't reliant upon coming back to the market to refinance debt or whatever it may be. So, Mark, the answer is therein lies the opportunity, both on the long and the short side, to take advantage of those situations. And you bring up a good point, because companies that have outstanding debt, you can watch where they trade on Bloomberg. There are plenty of companies that have debt trading in 60s, 70s, 80 cents, which, by the way, for anyone out there, to me, anything below 90 cents on the dollar tells you there's a massive credit red flag. And so you want to watch that, because you'll have people like on Carvana. You just brought up Henry, I know, is on the call, but you have people, Carvana, where the debt's trading at 60 cents and people are actually buying the stock. If you think that the debt's, 60 cents tells you that equity is worth zero. So I like to use those clues. And I know it's not easy for everyone to go out and buy bonds and so forth, but the argument that equity people make on chasing names like that, go buy the bonds. You're at the top of the capital stack and you have much potential better risk-adjusted return. So I don't know if that answers your question, but I just think you've got to start to look at all things. And I like to look at bond prices of companies that trade out in the marketplace to guide me on where the equity should potentially be. Because like I said at the beginning of this spaces, fixed income people are smarter than equity people. The good fixed income people just is, because they're forced to do that bottom-up work on those names on the balance sheet. So
there was a Carvana Spaces call, I don't know, maybe a month ago, and Henry ended up coming in, and that asshat Sosin was on there. And these guys were all thinking that Carvana's going to go to 500. So I have a bet with some guy that if Carvana goes to 500 without a reverse split, I'm going to buy him a Cobra.
I was about to say reverse split would be the only way.
And if it goes bankrupt, all I ask for is a kind word.
Hey, Marc, I got to interrupt you. You forgot already. You and I are in that room together, and you left that the most important part of the bet. If you lose, you were going to, I think, get dressed up in a dress and serve the guy.
I also said, other than the Cobra, I'm going to wear a dress and serve him breakfast, lunch, and dinner for a week. But the funny thing is you mentioned, if you think something's going to survive like a Carvana, borrow all the money you can and buy the bonds.
Exactly right.
Because there's no reason to play with the stupid equity here. Just buy the bonds, and I don't know what it is that people. I think George, the next thing is people need to look at balance sheets with income statements to realize what could happen next. Because some of these, because they may this time around come for these zombie companies.
Let me just say that, sorry, Mark. I was just going to say that they'll come for these zombie companies, but I just want to say one other thing. You also got to watch the people that are involved, like Ernie Garcia II, right? And when I started looking over a year ago at Carvana and just started to look at, I always like to look at who are the executives, where did they come from? And I started shaking up and down and more really in excitement when I realized that this was the ugly duckling guy. This is the guy that Steve Eisman and Vincent Daniel Meredith Whitney tagged in 1996, 97 for what was going to happen. I'm like, how's this guy who was a convicted felon, right? I mean, what are we talking about here? So again, not just looking at the balance sheet, but looking at who these characters are. It's amazing how people resurface in very different. And Mark, I know you've been on that, because you find the bad actors because they'll do bad things. People don't change over time. So I just wanted to add that aspect to it, because I think that that's also important on who the executives are at a company and where they've been and what they've seen. So, sorry.
Well, I just hope and pray Kevin O'Leary decides to run a publicly traded company again. I just hope to God that I can get just one more shot at him.
There you go.
I mean, that is just really, that guy is really something. But
Mark, stay there, man. This is great. We are getting the dream team together. All right, stay up there, Mark. Let's go to KFAB. Hey, KFAB, what's up?
Hey, George. Thanks. Danny, you said something that was right in my wheelhouse a little while ago with your experience during the GFC about the kind of the shocking spider web and how it had reached and had this kind of hidden interdependencies. With that, having lived through that and that experience, and I actually wrote something about this last week, kind of the Schrodinger's cat issue is, is the cat alive or dead? Or can they be at the same time, both at the same time, because some people don't even realize what's going on? Do you see, other than the name that shall not be mentioned, do you see any things that you see already, like 2, 3, fourth order effects of this cycle that no one's paying attention to? Kind of pockets of interdependency that are screaming to you that are overlooked? Maybe the obvious one to you, the fat pitch that has a hidden interdependency in that second, third, fourth order effect.
Yeah. So, I mean, again, I think the passive investing in fixed income in both corporate and U.S. Treasury paper is underappreciated, and that's why you see such volatility, obviously, in rates, right, that we're seeing going on. I don't think people appreciate that aspect of the market and how correlated kind of everything is. As far as, just we take it one step back, since we're talking about a spider web, I don't think there's any issues at the big banks. There will be blow-ups of little pockets of things, but there's nothing that, to me, is cataclysmic there, obviously, to kind of look for. Now, you can look at these banks' quarters and their balance sheets and start to figure out where the problems are, whether it's in a commodity, wherever it might be. But there is nothing that I'm seeing. What I am seeing is that as rates move higher and the cost of credit and the cost of capital moves higher, we have yet to really price that risk premium back into the market. So the one thing that scares me, and I said it at the very beginning, is you will have zombie companies that now tend to exist, that only exist because of the Fed's policies over the last 13 years and or QE 1, 2, 3, and 4 literally buying their paper. So the price discovery has yet to occur. So I think there's going to be a slowdown in issuance of corporate. We're already obviously seeing that. We're seeing calendar on the IPO on the equity side get hit. Again, that sits at the banks, but it's not cataclysmic. There's nothing out there that I fear that the banks are going to be in trouble this time. Could there be a product out there? I mean, look, we've seen what Bitcoin can do, just crypto wise. The leverage that's unaccounted for in the system. Like, you get an idea for kind of what's gone on and all these policies which have created kind of this cheap money print that's been going on. As cheap money goes to expensive money, we just talked about earlier before. When the tide goes out, you can see who's laying around naked. So there's not one thing I'm watching. It's just in general. And really, to me, it's that everything is correlated and that people have a false sense of security in some of these passive products. That's kind of how I would leave it.
Have you done any work on private equity and kind of the mismarking there and, the SoftBank and all that wonderful stuff?
Well, SoftBank, obviously, that was a name that, we've looked at for the last several years, and, mismarked portfolio. They get credit for getting one or two things right, and everything else has been wrong. Private equity is interesting because you still have such long duration assets, and the whole key, as anyone knows in this entire business, whatever part of the business you sit in, is that having that solves a lot of problems, like inability or to not have to basically liquidate your portfolio and or to earn fees that are locked up over a long period of time. Those are solid business models. To your point, though, I think you bring up a great point, actually. Some of these private marks have yet to manifest themselves. One is that there's no uniformity in people that own the same assets across the board, right? One person may mark it down 20 cents, the other 40. So there's no guidelines for that. The other is that you're starting to see massive markdowns in the private market in the same categories or same sectors as companies that exist in public, and the public markets are trading at a massive premium within those sectors to that group. So there is a lot of dislocation. I think you bring up a very good point in that market, and I think we're only going to see one direction for those to go, which is lower. And so there is leverage there. That is a risk, but I'm not running out and shorting Blackstone, off of that, given that they do have such long duration capital, ability to survive. So leave it at that.
Yeah, Danny, can I just follow up with a question, staying in that rabbit hole? I look at things like cash or higher global. I'm getting away from private equity and back to sort of like the growth side of things. There was a great article a couple weeks ago on Twitter. You probably saw it. Someone wrote a piece called "Infantilization as a Service," whether it's Uber and car rides or DoorDash or all the stuff people are too lazy to do themselves and they pay for. But all these models, where the unit economics don't work, it can't scale, they're loss making. They're basically just creations of the most irresponsible monetary policy in history, and they should go out of business. They should have never been in business in the first place. And I look at the posers, the fakers, the cheerleaders, or the pom poms, whether it's Kathy or Chase Coleman or all the rest, SoftBank, all part of this ecosystem, this web that you would refer to. And I just look at it, and I think we made a sort of generational high for that type of madness that we're not going to ever see in our careers again. It's sort of like, you go through different cycles and regimes, and 2021 is kind of like the opposite of 1981 with respect to valuations, growth versus value, all this sort of stuff. And I just look at some of the insanity that the levels of which insanity rose. And as the great Richard Russell once said, the hardest thing to do in a bull market is to stay fully invested. The hardest thing in the bear market is to stay out. And everyone's got this sort of recency bias, and they'll look at the valuation on whatever garbage you want to focus, Uber, whatever. It's all the same to me. And they say, oh, well, look, it used to be at 80 and it's now at 20. It must be cheap, blah, blah, blah. And I just think, and there's a question here, I'm rambling, but I'm kind of getting my frustrations out of my system. You have to put up with me. And I just look at the brainwashing. It's understandable. It's Pavlovian response to behavior of a whole generation of investors that know nothing but the post-great financial crisis environment, where it's just been pure liquidity driven, and it's been growth over value and narrative over fundamentals, et cetera, et cetera, et cetera. And I just think if you did nothing but run the other way for the next, few years, that'll kind of put you in the right direction. So I don't know what the question really is there, but I think what part of that would you want to respond to?
I would say this, and you can hate the game, but don't hate the player type thing, because what you just described, listen, how people make money is asset gathering, right? What are they forced to do? They're forced to put that money to work. The more that you put money to work, the more you can go raise another fund, right? So that's just the way it is. The problem, and Porter and Vinny and I, and Steve, this was always our philosophy, is that if you want to run a long short portfolio, you can't do it with tons of assets. It doesn't work. There's nothing you can quote short if you're running a $20 or $30 billion fund. Can you go short the SPYs? Can you go short a large ETF? Sure, you can balance out your book that way. And that's where we got, to your point. That's kind of where we are. So these firms got too big. Again, hate the game, don't hate the player. They took advantage of what other people were willing to give them. And so it is what it is. And so now, to your point, you have large pockets of capital sitting in some of these areas that probably have nowhere to go but down. We're starting to see the markdowns occur. Certainly the quote hedge funds that found themselves in tons of privates, right? And where they could park money, and whether they were not inflating returns, but whether it protected returns or whatever it was, that's just what it was. And just so this vicious, or it's not say vicious, but this treadmill that we've been on. And again, I go back to the Fed printing money and the money being free, and the money's allocating out there, and pension funds want to allocate into cool hedge funds and cool products. It is what it is. But hate the game, don't hate the player. And that's all goes back to, we've chased returns. We haven't done any price discovery on either equities or bonds for years. And now that moment has come. And so you better know what you own. And, again, funds are shutting down, right? I mean, this is not, so again, it's happening. It's just a slow train wreck that we're watching. So I think that answered your question, but I just wanted to mention, I think that's really what we're talking about. So
far more eloquent than I could ever be. Thanks, Jenny. Okay, we're going to go to Newman and then Always. And hey, guys, we got Porter in here as well. This is awesome. So Newman, Always, and then Porter. Newman, floor is yours. Unmute yourself, Marc.
Hey, Danny, great respect, man. I've known you from afar for over my career, so I'm happy to ask you a question here. You obviously had a strong opinion and a correct opinion on how the rating agencies and the CDOs contributed to the massive risk that we saw. And here recently, just in this convo, I've heard you talk about extra over-investing, if you will, nowhere to go. And part of my thesis here is ESG is maybe the greatest risk in the markets. And on a macro basis, we can see what it's done in underinvesting in oil and nuclear energy and leading to macro risk. On the micro side, like you said, people are piling into these names and not knowing what they own, right? Amazon, biggest global footprint, and it's the top 3 holding at major ESG funds. Then you have guys issuing new ESG garbage, greenwash, called Net Zero Pathway Aligned, and the fund looks exactly like every other ESG fund. So part of my concern here is that the rating agencies now in the ESG world captured by Wall Street and contributing to this bullshit. And so I wondered your thoughts on sort of, look, you've been around, I've been around. It's not a new thesis of mine that Wall Street garbles fucking products and turns it into a massive risk shit show where nobody knows what they own. And we obviously see it in the macro world. And I also done my work. I see it in the micro world. And I wondered your thoughts on the over investment in whatever it is, Amazon, et cetera, and how that plays out. And again, you mentioned as well, the function of Fed interest rates. And I think that is sort of the crux of it. But I wondered your thoughts on ESG potentially being this massive risk that nobody really can quantify, but it's there.
I think, ESG is, it started out as a great idea, really corporate accountability for how you run your business. It turned into a marketing tool where a BlackRock will go out and create an ESG portfolio, or, people that put together share votes will make sure that they get their seat at the table by you're not doing enough for ESG. And the truth is you can't change a car. You can't change a tire on a moving car. And so, the element of kind of being sensible and common sense of how you want to do it. And you're right. Everything came so quickly that money was raised. It was a great excuse to show that you're a good person. And I'm all about the environment. I'm all about social. I'm all about corporate governance. But it was done in a way and exploited in a way that it's created these dislocations, I think, which you're referring to the market. And it is complete BS. Now, I don't want to mention the stock again, but that large one that's an 800 billion market cap, to me, it's so ironic that they even, when they got downgraded, their ESG rating got downgraded, everyone was up in arms. But I'm like, all right, I'll give you a little bit on the environmental, but on the corporate governance, horrendous. And on the social, how you treat your employees, horrendous. So again, it is hypocrisy. But again, herein lies the opportunity. Companies themselves should have a program that their employees feel good about, that the shareholders feel good about, that they're not exploiting ESG for the sake of being owned in an ETF. And I want to bring up one thing, which I think is actually, you just made me think about something else, is if you're the CEO of a company and you know that there's ETFs that runs in the tens of billions of dollars that are associated with ESG, you will start to manage your business to be part of those ETFs. And I go back to even dividend paying ETFs, and this is the problem with passive investing in general. When you become prisoner to your top 10 shareholders not being human beings, but being algorithms and computers, we have a problem in general. And that all dovetails into this letting a marketing or a theme control your investment process versus the bottom up. So I don't know if I answered your question. Do I think it's being exploited? It's being exposed now? Certainly. But I hope that every company out there is already doing what they should be doing, and they make you can't be an energy company over a long period of time and think that you're going to adhere to these principles that ESG occurs. And yes, is it to blame for some of the lack of CapEx? Yes, it's created some of these issues, which are being amplified, obviously, by situations globally, right? So again, we always take a crisis of some kind to magnify the problems that have always existed. And so it brought it out, and it is hypocrisy. And I don't think it's a problem. I think it's an opportunity to kind of trade around it. So,
yeah, that's great. And I just wanted to add one thing on that, as you mentioned, the ExxonMobil story. Them offloading assets to like a less scrupulous private equity holder. Maybe it's the Mideast, maybe it's someone here in the States who we might know. The actual energy equation hasn't changed, but Exxon's visibility in the ESG world has improved because they offloaded assets. And that's, by the way, part of the reason why Tesla fell in the rankings, because Tesla actually didn't change anything, but relative to ExxonMobil, they fell. And then one other last thing, you mentioned the car, Danny. I think that's a great analogy. What I like to think about in the energy world of ESG is we're all on this ship and it's sailing in the middle of the ocean. And the ESG captain has said, we need a new boat. And rather than say, hey, let's go to the stateroom and let's figure out what this new boat looks like. Quick, everyone coming, and we'll figure out what boat we need. And I kind of think that's where we are in the ESG energy world. And so thanks for that, Danny. That's really
You
great.
got it.
Appreciate that. Thanks.
Yep.
By the way, for those of you who don't know him, Marc Newman, he's a good friend of these rooms, really smart guy. He has launched an ETF, Constrained Capital, ticker symbol, if I got it right, ORFN. And, I think Marc speaks truth. Urge you to check it out. Smart guy. Been around, and I think it's going to do extremely well. But again, this is not investment advice. Do your own work. But if you're looking for a way to think Marc's making sense, please check out his ETF. All right, let's move ahead. We're going to do Porter. We're doing Always and then Porter. Always, the floor is yours.
Awesome. Hey, Danny. Big fan of your work, especially the podcast that you do with Guy and Dan. But with some of the recent, I know you're a big fan of the cannabis space, and of course I couldn't let you go in this meeting without talking about it. But just curious with some of the comments that Cory Booker had recently in that Senate hearing. Curious what you think about the space, and if I might add one last thing, you got to get Brady Cobb back on that podcast. Big fan of his work as well.
Yeah, he's coming on, I think, in the next week or so. So listen, from a macro perspective, I don't think there's any question out there how strong it is. From a micro perspective, companies having inability to access normal capital markets, whether they have to use their stocks that trade on the CSE, which is the junior exchange in Canada, to raise capital, it just hasn't been friendly to them. Couple that with the tax code and the banking. So listen, we're at a point right now where I think we finally are going to get some type of banking regulation that passes. I think it will be the SAFE Act. I mean, Brady's very, very, very involved in that stuff, so that's why I want to have him back on. So I think cost of capital will start to drop. I worry that some of the incumbent stocks have now been around so long. I mean, these stocks have literally gone down 50%, but their market cap is the same because they've been forced to issue so much equity because this has taken so long to happen. So you have a sector where the CPG companies, whether it's alcohol, are waiting. They're the barbarians at the gate waiting to come in for any law change that allows them to go buy up everything in sight. I think you'll see tobacco, you'll see alcohol, everyone come in. So the answer in a nutshell is you have an industry growing like crazy when you look at the tax revenues in Colorado, Illinois. We know it has economic benefits, but the companies can't achieve economies of scale because of the state-by-state basis. It's like running a separate company in each of those states. So therein lies the mismatch. But from a macro perspective, I've never believed in it more. From a micro, you got to be careful that you own companies that are going to make it through this. And I think there are several that will. It's just going to feel like a NASDAQ 2000 issue where the stocks eventually work themselves through the companies that had a very good business plan and balance sheet, and they'll be there. So they'll be winners, certainly. And, there's a lot of other names which I think will benefit that provide ancillary services to these companies. But we're still in inning 3. Unfortunately, we've been stuck here. But I do believe real regulation is coming. To close it with the comment that you made on Booker, that was a pivot that he made about banking. Schumer's going to back off from full comprehensive bill, and I think they're going to pass this thing. And Perlmutter, and it's one of the more bipartisan deals. And in this economy, which we're going to see over the next 2, 3, 4 quarters, give me a sector that can produce more jobs and more revenue than that. There isn't. So leave it at that.
Thanks for the question.
Danny.
All right, let's now move to Porter, followed by Oil God, followed by Andrew. Porter, good to see you. What's on your mind? Please.
Hey, Bray, man.
Hey, how we doing?
Good. How you doing, Porter?
I'm doing great.
All
Doing great. I'm on Georgia's Spaces. Is a lot of bears on board, so I'm enjoying it. So my sort of question and storytelling is that James Aiken, who's been a longtime friend of ours, obviously, and he came into our office in 2012 or 11 when Mario Draghi did his whatever it takes, and he came to us and says, "You know what your guys' problem is? You think too much." And he goes, "It's time for you guys to stick your head in the sand and not think so much about markets and just follow the flow of what the stupid central banks are doing and sort of ride the liquidity wave." And as I sit back and think about that now and think about this environment where it's the 100% complete opposite of that environment, it's time for everyone to pull their heads out of their asses and look what's going on. And you sort of have this peak Fed and everyone is on the conference calls, and frankly, I don't even listen to it anymore because it's all BS and it's all plate spinning type stuff. And so, my question to you, Danny, is that obviously we know monetary policy acts with a lag, and the lag's coming. And how do you think that, like, just the mismatch, and everyone's buying ETFs and trying to day trade, and as George points out, like, people are just missing the forest through the trees of fundamentals deteriorating, the liquidity's coming out of the market. That look at the high yield ETFs, volumes are way down, and that's the lifeblood of all these junk companies, right? Marc Cohodes talked about Wayfair, and how are these companies, or Carvana, how are they going to access capital? And so, just talk to your thoughts about this cycle, and we get frustrated how long it takes to play out. So just give us your 2 cents on that.
All right, so let me just comment on J.I., as we call him. He's been incredible. He was a huge help to us, even when he was writing notes from a small island when he was still on the sell side at UBS. So he goes way back, and having worked at AIG, he got to see the inner workings of everything that was going to occur. So, Porter, just as an example, he hit me 3 years ago or 4 years ago on Tesla, and he called me, goes, "You're too smart. Stop wasting your time. You're going to get frustrated." And again, he was right. So anyway, it really comes down to don't fight the Fed on the way in or global central banks printing, and don't fight it on the way out. And it's really that simple, right? So there was no price discovery. As you, Vinny, and myself were running Seawolf at the time, we wanted to believe that we could make money, that we could create alpha, which we did fine, but we were hurt by the fact that the yield curve was being totally manipulated in a sector that we covered, financial services, and we were doing brain damage to ourselves by trying to do fundamental work. And it hasn't mattered for so long, and it's such a lost art. And now here we are. I said it a year ago, this would be the greatest stock picking environment and bond picking environment that we're going to have I think in this generation. And it's here. The problem is, if you think about the average Robinhood, which is now literally losing accounts by the day, the average age of the Robinhood trader was 32 years old at its peak. Think about that. They hadn't seen anything other than the global central bank prints money and has your back. So here we are. Horrible Wall Street research, except for a few that are out there, including some global strategists like Aiken and other people that are out there that people should be listening to, that understand the plumbing in the markets and how it works. So when you wake up and you see the reverse repo market imploding, you're trying to figure out, what does that mean and what can I take away from it? All those things are now going to start to matter on the way out. And so your point, Porter, is that risk has been mispriced for 13 years, and now it's not. And the Fed has been begging you to sell stocks. Fed is telling you to sell stocks, and no one's listening for the most part. Some of us are screaming at an old man screaming at a cloud, but it's here now. And so the answer, I think, to your comment or question is, start to do work on bottom up. Everyone on this spaces loves the market, loves the history of the market, is passionate about it, loves the characters in it, and all these things. And we are now being given an opportunity to do work on names that you can make money on the long side and on the short side. And I think that lost art is now coming back in full circle. I mean, think about the amount of hedge funds and people that we know that have shut their funds down. Smart people that you want in the marketplace looking at stocks. You want them buying and shorting stocks. It's gone. I mean, it's gone. So that's coming back. So I think your performance with Vinny, since you guys dumped me 3 years, speaks volumes. How well you guys have done in this kind of environment, being able to look through other sectors other than banks and financial services. And there is a huge amount of opportunity out there. So I'm excited. I guess I'll say this. I'm excited that for the first time in 13 years, you actually can create alpha in this market. So I don't know if that answers your question.
The amazing thing is, Danny, you were jumping around and talking about it, and we were too, and Henry was about, Upstart and Carvana and just the financialization so much of these companies. And listen, financing stuff is really easy when markets are really easy. But you made the comment and said, listen, in 3 months' time, the tech guy is going to go over to the financial services guy and goes, "What's a securitization? What's a loan loss?" And sure enough, that's exactly what happened. And fundamentals are starting to matter for the first time in a long time. And buying ETFs is to me it's useless. I've never been a proponent of buying ETFs, and I'm a single stock guy, and you can control your risk much better that way.
For those that are out there, let me just say another hammer on the Wall Street banking research system is that when a company comes to these firms to raise capital or go public or whatever, it's the bank's job to silo them into the appropriate category. So Porter just mentioned Upstart, quote, tech platform, a tech company. Fine, stick it in tech banking, tech multiple revenues. Don't look at earnings. Don't look here. Don't look that they're using a rent-a-bank to grow their business, and they're completely reliant that if their performance of their credit starts to deteriorate, that those banks will cut off their lines. The same way that these mortgage companies, subprime mortgage companies, had credit lines from the banks. They look like these incredible money-making machines, yet all it took was just a line of credit being cut to make them go out. That's what happened. And I called the buy now, pay later, which is the Affirm short now, cover later a year ago, because I kept saying and Vinny always says, you cannot commoditize lending. If you're growing your lending faster than GDP, you have an underwriting problem. You can't use AI for lending and all this stuff. And again, it becomes, you feed the machine and it's self-fulfilling. So again, it's so interconnected in the web that's out there, and companies like this that emerge. And so anyway, it was
all bullshit. They talked about this AI lending strategy. It was only during the downturn where they're like, oh, we got to change our assumptions for the, what are you talking about? They were stratifying, customers. They had no concept of history of the credit cycle. They were the most aggressive at the end of the cycle. It's freaking crazy.
So
you got me.
It's so frustrating.
Yeah, let me jump in. I want to ask a question for both Danny and Porter and Marc, the three of you. We got murderers row up here. I'll go Porter first, second Danny, third Marc. Relative to the opportunity set of the last, say, 13 years, how would you describe this? It's softball questions, T-ball time. I'm sorry. This is for you, Porter, first. How would you describe your confidence in your ability to outperform the market right now if you were running a long-only fund?
Well, thankfully, I don't run a long-only fund, and Vincent and I sort of started we call it Seawolf 2.0 after.
Yeah, let me recast the question. How would you characterize the opportunity set right now, given the way the character of the market's changing?
Well, I'll give it Danny style confidence. This is the best stock pickers market.
Let me just chime in, George, because these guys.
Hey, Marc, we can't hear you.
These guys, Porter is too diplomatic. I think Porter and his fund are up 85% in the first half. So his confidence level should be very high because he's knocking it out of the park. I mean, he is knocking the cover off the ball. So I'll answer it for him. His confidence level, sky high, but he's too good of a guy to say that. And my man Henry, the guy who had Carvana, I think he's up 225% in the first half. So these guys who do their work and guys who can figure it out, this is their time because they're seeing the pitch and they're doing the work while others don't even have a clue what the work is. That's the trick. That's what experience and being good at your craft gets you. Because I can brag about these guys, and they're my friends, and I'm very proud of them, and I'm lucky they still talk to me. But if you know what you're doing and stick to what got you to the major leagues, you can kill it here. You can absolutely kill it. And these guys have killed it. So I just wanted to give that editorial comment before Porter actually answered that. So there you go.
Well, Marc, thank you for that, because Porter is a gentleman and he does it by the book, and you can say things he can't say. So, Porter, I don't know.
Well, I'll tack on one or two things. Listen, the structure, the market structure has been just completely bastardized by algos and ETFs. This is my opinion, of course. Algos, ETFs for so long that, they just leave, to talk about what Danny was talking about in terms of, they put Upstart in the wrong bucket. That was just an opportunity for guys like myself who are stock pickers. And, frankly, this room is probably a bunch of stock pickers. And the same way that ESG completely destroyed oil and energy stocks. And listen, our trade basically this year has been long energy and short bullshit. And even after the sell off, they were completely overextended, and the energy stocks had a big sell off. And if you do the work and your names, you don't get scared. You actually buy more rather than, sell. And listen, I'm very nervous of a recession. Obviously, we're here, but you still know the cash flows, and you still know the ability to go to the bottom of the well, buy more stocks, and know where the bottom is, know where the value is. Even in we underwrite stocks under a really depressed, bad scenario. And so your ability to buy stocks at those levels when people are freaking out and everyone's dumping stocks at the same time, I think it was Upstart when they squeezed us in Q3 or Q4 last year, the stock rallied 50%. We were shorting the crap out of it. And so that's why I think that, you look around and Twitter or you talk to everyone, so many people are confused, and it's confused everywhere. And I think if you just stick to your fundamentals, ignore the Fed's, rhetoric BS, because they don't know what's going on. Clearly, they're spinning plates, and stick to the data. And that's why I'm just so bullish about the stock pickers market. This is the most fun I've had since 07, 08.
Let me just interrupt before we go any further here. I have to be careful what I say here. The fact that you guys are having so much fun, and by the kudos to you, Porter, I'm really happy for you. That's awesome, and it's just great to hear. It gives me some hope. You probably are all aware I have filed for an ETF, which is in registration, waiting approval from the SEC, which is basically going to be a long short absolute return fund. And I can't speak about exactly strategies at this point, but we're in registration, and it's a lot of the opportunities that you're talking about, the dispersion, the extremes, the disequilibria, which I just think this is a golden age for stock picking. That's why after a dozen or so years, actually more, 13 years of not running public money, I went and got my bat and glove. I'm going to get back in the ring. So and by the way, Danny, you were talking before, you want this to just get it over with and hope everything should crash and just let's get on with it. No. I want this to be a long, drawn out affair.
Yeah, let me dovetail on Porter's comment. I think it's really key to understand what is your duration of capital that you have. If you have outside investors that are redeeming because they have issues in other parts of their portfolio outside of you, you are beholden to them. So in a perfect world, you have long duration capital to take advantage of the nonsense that occurs in names like an Upstart for a period. Because let's be clear, if you're running an institutionalized hedge fund and you got to write that quarterly report, do you really want that thing out there if you know it's not going to come? So I think behavioral finance aspect of that combined with duration of capital, you got to do two things together, right? And I think so. Reporters saying, and Porter and Vinny have been out there really managing most of it, their money for a period of time, which is better than anything else. It's given them the ability not just to think clear, but not have to worry about, because it's just the truth is in the real world of institutional money management, you have to deal with that stuff. It's a distraction. It is what it is. It has good parts and it has bad parts. So I think you need to kind of delineate that aspect of the business right now. And I think for someone, and that deals with any individual, no individual has to report, well, tell people how they're doing, but it's your money, so you can do what you want with it. So I think it's key to understand that aspect. And I'll just add that, for better or for worse, a lot of hedge funds are coming out of the market and have been now for several years. And I don't care if you're long or you're short, you want those hedge funds around, because shorts are a buyer of your stock. It's a buyer of that stock at some level, barring bankruptcy. They have pent up demand for a name that's out there, and they help the markets function. So we won't talk about short selling on this call, but let's just say that I think it's an important part of the market that people tend to blame or misguide. So anyway,
couldn't agree more. Let's go to a couple. I want to take this a little bit out of order. I'm going to ask you to hold it for a second, just because I want to keep the continuity of this thread going. And Marc, Henry's here now. So Henry, welcome. Please unmute yourself.
Hey George. Hey Danny. How's it going, guys? Thank you for having me.
Henry, who's up 225%, and he's so driven. He complains to me when he has a drawdown, and I said, "You're up 225%. It's okay. It's totally fine. Just keep doing whatever you're doing to get you up a deuce and a quarter. Keep doing it. Keep doing what you're doing."
I appreciate that, Marc. You're a nice guy. We're all in this because we are competitive people, and we want to do the best. So
Henry, I like about 16 and 5/8 people, and the rest of the people I can't stand. So I happen to like you. So
I appreciate that. Okay, so I have a question for Danny or for George or whoever wants to take it. It's interesting. We have a lot of very smart financial guys on here that are risk averse, humble, think about what they don't know. And so, it's common for us to bemoan the meme stocks, to look at guys that either grew too big or weren't thinking about risk in the way that they should during the last couple of years or the last decade or more. And all roads lead to the Fed. We can argue, to what degree and whether we're sort of, where are we in that? But I guess, as someone who is a concentrated and often contrarian investor, the three most important words for me always are, maybe I'm wrong. And so I guess maybe just to play devil's advocate, to get into something that Danny, Porter, you guys are very familiar with last time around, which was the too big to fail, the moral hazard issue. The reason that we're seeing this jawboning, I think, other than the buy the dip or the algo kind of driven market, is that a lot of guys are thinking many of these names, these mispriced, super risky, return-free kind of risk assets, are too big to fail, or that the bailout is coming. And so I guess, the question is, how do you think about that? How do you think about that probability or scenario unfolding?
Can I, Danny, let me just take a shot at that before you go, Danny. So, Henry, that's a great question. And actually, I'm emboldened by what I believe to be is the answer to that question, which is, it's not the banking system's integrity at stake here. I mean, I actually view, and Cohodes didn't make me say this, I've said this before, I'll say it again. I actually think blowing up DoorDash, having Uber go bankrupt, having Peloton go away, these are all good things. These are positive things. These are good for the economy. I know people think I've lost my mind. No. What I mean by that is we've seen such a gross misallocation of resources. This has to stop. I can't remember how many hundreds of billions or trillions of dollars were spent on Tesla call options last year. You combine that, I think, with total energy capex of $100 billion. Talk about misallocation of resources.
Right.
Tiger Global needs to go out of business. Cathie Wood needs to go bankrupt. All right. Then we'll start allocating capital properly. So, no, I'm not. Now, listen, obviously, if this all goes down the shitter, yeah, I mean, there are a lot of lines of credit. The banks will be in trouble on private equity. Oh, I get all that kind of stuff. But on first round, who takes first loss? It's not the banking system. It's sitting in, unfortunately now, it's sitting in the portfolios of a lot of 401ks because, the electric car company, which shall not be named, even that's in the goddamn S&P, all right? This stuff has to stop. It will stop. It is stopping. This is the way the system is healing. Sorry to get up on my soapbox. Danny, over to you.
No, I mean, we're weaning off of a drug here with the Fed, and that never is easy to do. And if you're a short seller or you're a fundamental investor, you want to believe that you're not you aren't going to be impacted or have to worry about this bogeyman that's coming. Whether it helps you or hurts you, it's just a tough thing to factor in. And I think, to your point, will there be credit lines that get put out by the Fed if things go haywire? I 100% think that they will be. To think that the Fed's not going to react at some point or come back, to the markets if they need to, I think is now that is a lot lower from here. That's we're talking sub 3,000 on the S&P if those things start to occur. Listen, they were buying during COVID. This same Fed was using the HYG and J and K and going out and buying things. I mean, come on, like it's just crazy. So I'm not arguing with you. I'm just saying, like, this is me exploring. So you do all this work on a company, you go short it. You see the credit's trading at 50 cents on the dollar. All of a sudden, the Fed comes in and sticks out a line for $100 billion for high yield companies that are triple B or lower to access. And what do? Stock goes up 150%. You got to sit there and take it. So the answer to your question is PTSD from the Fed will always be there. It's going to be there for years until proven differently. And so that has to be in your mindset, for better or for worse, and in your risk management protocol of how you're looking at certain things, and use options here instead of stock and do all this, protect it. So the answer is yes, it does go in because it's sitting there with the devil and angel on your left and right shoulder. So that's I don't know if I answered your question, Henry, but listen, at the end of the day, 2-7 offsuit, bluff, meme stocks, you got to show your cards at some point. And so that game can go on for 10 minutes or it can go on for 5 years, but eventually fundamentals matter, and that I'm a believer in, and I will always be a believer in. So
absolutely. Thanks, guys.
Thanks. Hey, we'll go to the next speaker, but well, God, you're next in line. If yours is an energy question, I'd like to hold it. If you want to speak to what we're talking about now, that's great. We'll get to you if it's energy. I just don't want to go. I like the thread we're on right now. So, God, do you want to speak now, or do you want to hold it a little bit?
Thank you, George. I got an inflation question, and then I've got one on liquidity and hedge funds, and then I do have an energy one, but we can come back to
I tell you what, the first two are fine, but the energy question, let's not go there. The energy we'll save for later. Go ahead, Olga.
Thank you for the permission, George. I'm very humbled. And nice.
No, come on, dude. It's just like, people love when we stay on point. I just don't want to go all over the place. Not that I'm trying to avoid energy. I just don't want to go there now.
So, Dan, nice to see everybody in the murderer's row, as George says. And, George, you're absolutely right. It is murderer's row. With respect to inflation expectations, you used the analogy of ESG earlier of, trying to change a tire while moving a car, or the boat analogy. So, in your opinion, just using rational thought, is inflation expectations in your camp just set to continue to run hotter and for longer? Because obviously yesterday's short covering Fed fake out, I thought was absolute bullshit. And so that's my first question on, how are you baking in your inflation expectations moving forward? And then the second one, with respect to the hedge funds, what percentage of the closing do you think has to do with what we call saleability? Because if you look at the things that are actually working in the market, and we're not allowed to use the word energy at this point of the show, but if you look at the things that have been working this year, it seems like the people with the most money in the world, the people who would be the clients of the hedge funds, aren't necessarily receptive to be purchasing those types of, investment solutions or positioning of a portfolio looking forward. So are they closing because they can't sell what it is that's going to work, or are they closing because they genuinely have no clue what to do? Back over to you.
So, so on that last point, when I was talking about hedge funds that are closing, it's just that either their performance has been poor, or they were caught on the wrong side of a short squeeze and exposed in the media, which created a whole nother issue. Or to the point I made before, you get to a size in a fund and it's just impossible, especially in a market like this. You're truly just a long only. You can't run net short. So what you're supposed to do when you charge these fees in a hedge fund is to, provide risk management to be able to obviously benefit or produce in any, down market or up market, and they just got too big. So I think just the realization of those business models market themselves in one way, but in actuality are just long only shops and, wolves and sheep clothing or whatever. So that's the first part. Second part, I think, question about inflation expectations. The biggest fear for the Fed has been kind of wage price spiral, right? It's been the if people believe that inflation is going to keep happening, it's self-fulfilling that it's going to occur. The problem with that is that even wages, which I think are the sticky part, you either get laid off, you don't get your wages dropped, you get laid off, you get fired, which is a whole other unemployment issue, aren't keeping up with inflation. And this is stagflation. I've talked about this for a long time. That's kind of where we are. But again, nothing looks now like you learned in history books. This is its own cycle. So I think this is the most unique cycle that combines a piece of the 70s, the 80s, the 90s, and the 2000s all into one right now. And so that's why I think people that have been around long enough to not trade through all of it to be history of the markets, and behavioral finance to me is a lost art. And I think that's coming back the more that we stock pick. That has a massive aspect. That comes back. Therein lies the opportunity. I think inflation has peaked. However, from a supply chain perspective and geopolitical risk, Ukraine, and if you just look at Germany, how do you start to quantify not having power? I mean, I don't think people have realized yet that maybe people in Germany have, and people in UK that are paying 100, 500 times the amount that we pay for energy right now. That's a massive issue. So you have inflation being measured in energy and things that we can't control. I don't care how much you produce on ESG perspective, that would still have been an issue that Russia is controlling that pipeline, Nord Stream. But how do you factor in that? And that's stagflation. That's high inflation that literally halts economic growth. And so I'm not tracking inflation expectations necessarily. I'm tracking consumer confidence expectations and then watching inflation as a gauge. And I think it's peaked. What that means is not meaningful because relative to wages and everything, like I just mentioned, purchasing power is diminishing regardless. And so that, to me, to bring that all the way back to kind of fundamentals and how the macro, how you look at the markets, that's what matters more. I don't know if I answered your question, but
that was excellent.
Okay.
Yeah, Dan, thank you. No, you answered it. It was a very tough and convoluted one, but I agree with
it's all
you.
good.
Right. You've got a situation that is just literally spiraling out of control. George, I give it back to you.
Yeah. Oh, God, just hang around. We'll come back to you on oil in a little bit. I just wanted to keep the
George. What's our time on this?
So Danny, you go whenever you want. You've been more than generous.
Okay.
With time. I have this bad habit of running these rooms for 2.5 hours, but I was thinking we keep you for an hour. You're in overtime now, man. So
I'll hang on for 5 more minutes if that's cool.
Hang, that's great. If you don't, that's totally cool. It's a real treat, pleasure to have you here. Let's go to Andrew. Andrew, please unmute yourself.
Oh, hey, Danny. Great spaces. Thank you. Just wanted your take on the buyback spigot. Do you think it'll be turned off all at once? We've seen Starbucks, JP Morgan, and Best Buy recently, but it's been a little slow in my opinion.
I think that's company specific. I do look at those things. Obviously, balance sheets have a big impact on your ability to buy back stock. JP Morgan and many of these other banks would be buying back stocks hand over fist if they didn't have to adhere to some of these ratios, capital ratios, risk stress test type stuff. So it's very, it's hit or miss. But you did have a slew of companies that were borrowing at zero basically and just buying back stock. And the point that Marc Cohodes made earlier and that I made before, that's not a sustainable earnings driver. You can lower your share count with that, but you just leveraged your balance sheet. And what is the duration of that debt that you took out in order to buy back stock? So eventually, that money is no longer free. So I think a lot of the buybacks had to do with literally borrowing at zero and just buying back stock. And by the way, that's what companies are supposed to do. If you want to increase shareholder return, go buy back stock, do whatever. When you talk about the energy sector, and you want to look, just to bring that back up for a second, these companies could literally buy back half their companies with the cash flow that they're. So I like to look at it and see what is the ability of a company to do it versus are they actually doing it, and what is the inability of a company to do it, because it's a very stock by stock basis, and it can be a very powerful tool, or it can be something that's masked, that's been used for so long in a company that you think all they're doing is decreasing shares outstanding to grow their earnings. So anyway, long-winded answer to your question, but there is no uniform answer to that. So
hey Danny, two. Let me drill a little bit further on that one. 2 questions. One, I got a real problem with companies like American Airlines, who or Boeing, who buy back. Let's just say American Airlines, they buy back billions and billions of dollars worth of stock, have a crappy balance sheet, then the shit hits the fan, and they go panhandling, ask the government for a handout. One. And then 2, the extent just more generally with which company management just abuse, stock buybacks. Any thoughts on that, on either of those 2 points?
Yeah, well, the airlines are a whole nother. Don't get me started on those. I mean, times are great for them. They overcharge the consumer. Times go bad, they get bailed out every single time over and over again. Now you just you made me think of something else, which is stock-based compensation, which is a whole nother thing that should be looked at. People excluded in their earnings report. Why are you excluding stock-based comp as part of your operating earnings? It's you're not paying people. And so this whole EBITDA, this whole X-based comp, that's a whole nother issue. But yeah, capital intensive.
No, you mean you actually want to pay attention to GAAP earnings? Like you're a dinosaur, dude.
Exactly. So anyway,
right,
this all goes back to the same place. Again, bottom up, understand what you own, fundamentals will matter. None of this has mattered for years, and now it does. You're going to listen to these, look at these companies. When we are just at the beginning of earnings we're already pre-announcing, but earnings degradation. So it's just beginning. So so what happens? You get put under the microscope. If you're put under the microscope and people run scared, they're going to say, why is the stock selling off? Why? And then they'll start to say, oh, why weren't any of those research analysts on the sell side mentioning any of this? And you know what they all do, the research analysts? They'll downgrade all of these stocks down 70 to 80%. Because at the end of the day, when they know there's nothing left to squeeze from them, no debt issuance I can help you with. No buybacks I can do on my desk for you. No, that's where we're going. So answer your question is, a company with tons of debt that goes to buy back stock and leverage their balance sheet more, is that the best opportunity for shareholder growth that they have? If it is, you should be really scared. So,
all right. So Danny, stay for one more speaker. Because,
by the way, put Vinny up in my spot when I leave if he's on. Just put Vincent up there. I don't know if he's still.
He's got to raise his hand. Okay. So the smartest guy in the room always sets us straight. Our good friend Michael Kantrowitz. So Kantro, I hope you've been triggered by some of what's being discussed here. You've been quiet in the audience. So welcome. What's on your mind, Michael?
Hey George. Hey Danny. Thanks for doing this. I jumped in a little late, so I missed a big part of the beginning. So I look forward to listening to the replay. Just want to ask Danny, a lot of the things, I hear you saying, I totally agree with. And, what we're struggling with, and we have a view that, we're in two back-to-back bear markets. The first part came from higher rates. The next part's going to come from the impact of higher rates on earnings and employment. Pushback we get nonstop is, it's all priced in. So I want to ask you, how do you think about what's priced in, which is, the argument people are making that, all of a sudden everyone can see everything much clearer than they ever have in the past, that versus the lag of tightening, and that knowing that we're going to see much more of a downturn over the next year or so, and how you're balancing the peak of one problem, potentially inflation, and the ongoing rise of the next problem, and how markets are responding right now. Thanks again.
This whole market has been about immediate gratification. It's been the gamification of the markets, whether it's trading in Coinbase, gambling on DraftKings, or trading on Robinhood. And so people are seeing things in an hour, a day, or a week type of environment. So that argument you just kind of talked about, that you get that question, that's why we're nowhere near the bottom. Because we haven't even begun to see. I mean, the Fed hadn't even really raised rates yet when market conditions were tightening, when financial conditions were already tightening. It was already happening. We have yet to see. I mean, rates are still so low historically. We haven't seen anything yet of what this might look like. So my answer to that would be, it is a lag. It is happening. And that's why I think we're going to continuously see. I mean, you're already seeing what can happen just from a small raise. Because think about it. Companies are reporting now what the Fed hadn't even gone, twice? I think by the time that the second quarter had closed, maybe 3 times. I got to go back and look. But we had just started this rate cycle. So I go back to, why would the Fed pivot, or why would the Fed, reverse course? It'd be because things deteriorated rapidly. And there's no way that rapid deterioration in fundamentals is being priced in to the market. And you still have quantitative tightening to reckon with, which has just begun. And the market will front run that trade. And that's why credit spreads are widening. That's why mortgage spreads are widening, because they're front. That's not going to undo itself quickly. So answer that question. And then your second thing was on inflation. I believe you said, how do I think about it as it relates to kind of market?
I guess, what are you looking for that will potentially eventually squash the euphoria of inflation peaking as the lag effect kicks in of all this tightening?
Yeah, because I think I just said, so I think that you'll have sustainable inflation. It will work its way back down over time. It has to. I mean, whether it's in a quarter, 2 quarters, 3 quarters, or 4, it will. But why would it work its way down? Because demand is what the Fed wants to see drop off of a cliff, which it will. So I like to think of it more, not as an absolute, but how do I think about it company by company on what supply chain freeing up means. What, just look at Walmart and kind of what they're saying. To me, they're a proxy for a lot of things, that are going on. Like, what is the consumer spending money on? Consumer's not spending money on goods, spending money on services, right? Because that, just take those pieces of information, and it doesn't take a brain surgeon to look at one of the largest components of the inflation print that we saw last month was from gasoline. Well, you can compute and figure out quickly that means that we've seen, at least during this next several months or several quarters, peak in inflation. But how do you extrapolate that into what that means on the macro, and how do you extrapolate it to what it means on the micro? And I think you have to do both, right? You have to kind of try to guess how the market's going to react to something, but there's no right answer for that. I just kind of use it separately. What that means, when I see gasoline inventories a certain level, that tells you where gasoline is going, right? So again, there's demand destruction began 3 months ago from the Fed raising once or twice, or indicating that they were indicating the end of quantitative easing and reverse to quantitative tightening. So there's a lot to manage out there. That was a long-winded answer. Because there is no one answer to that question. So I don't know if I touched it. Yeah.
Thanks, Cantor. Hey, Danny, before you go, your pal Vincent's here. So, Vincent, you want to say hi to Danny? I know.
Hey, man. What up, Danny? Can you guys hear me?
Yep. Vinny, take my spot. I'm gonna go off after you ask this question. So what do you got?
Will do. I don't have a question. I just got a few statements, and I'll be quick. George, what you're doing for investors on Twitter is incredible. You mentioned and referenced sell-side research and the like. I think Porter and I can attest that the majority of our research budget, or just brain matter, is spent on Twitter. When we have ideas, we go down rabbit holes on Twitter, and we use the sell side far, far, far less than we did when we were institutional money managers. So the stuff that you're doing, I thank you, and it's fantastic. And I'm just going to on the tape on a weekly basis. It is by far the most entertaining and informative combined podcast there is in Podcastville, and there's a ton of them, but they do an incredible job. And Danny, you're the best.
Thanks, man. Well, that's because we have you guys on, as guests all the time. So they're coming back soon. So stay tuned. So thanks, Vin.
Answer the question that if I could answer a question that was asked before in terms of when are we going to see inflation decline? Like I have an odd view. Maybe it's not odd. I actually think the leading indicator in a financialized economy is the rate of interest. It's by far the most important thing that matters. So as rates rise, the economy slows down. Conversely, if rates decline, financial conditions and economic activity picks up. So to me, the Fed's in kind of a pickle. They want to stop tightening. They don't want this. But if they stop or blink like they apparently did yesterday, the first thing that happens is the price of oil goes up, the break evens start to go up, and inflation expectations go up. So I really don't know how they get out of this over the next year or two. I mean, they're really in a pickle. It's in a bad spot. And then I'll shut up.
Vinny, why don't you just say other side of
Goldilocks? I can't.
You won't say it.
I can't say it.
Okay, other side of Goldilocks.
Yeah.
All right. All right. That's a great point, though.
Well, one of my rallying cries, Danny, you haven't been in my rooms that much, but I keep saying to people, Tina is dead, FOMO is dead, Goldilocks is dead. I mean, I don't know what we're going to get. I'll tell you one thing we're not going to get. We ain't getting Goldilocks. She's gone. There's an APB out for her. She ain't been seen. She's 6 feet under. She ain't coming back. And that's what this 13-year haunted house of a stock market monetary experiment has given us, Goldilocks, and she is gone forever. So anyway, that's just my 2 cents. Danny, you've been more than generous with your time. I hope you'll come back. This has been absolutely awesome. It's been one of the best rooms we've had, and this has just been terrific. So thank you. Thank you, Danny.
Thanks for all you do. All right, see you guys.
Yeah, thanks, Danny. All right, let's move on here. We're going to go to Blake and then Zach. Blake, what's up? Blake, please unmute yourself.
Hey, guys. Can you hear me?
Yeah, we got you.
Hey, so I am far less experienced than you guys, and I'm not normally experienced with putting my thesis out there. So I just wanted to ask if anyone follows RCL as a short. And I guess I'll just give you things that I'm going off of and see what y'all's comments are.
Wait, hold on. This RCL, is it Royal Caribbean? Is that what you're talking about?
Royal Caribbean, yeah.
Yeah, okay, all right, go ahead, yep.
The one thing I did like was this is the first time sell-side and analyst had called them out, so to speak, on the conference call this morning. Steve from Stifel, the very first question was about their refinancing their debt and how they're going to deal with it. And of course, Jason Liberty dodged the question, basically. But they do keep maintaining that they plan to refinance all of their maturities. And I've done the numbers on their posted public schedules on their website. So through 2023, and I'm using that number the next 6 quarters because what I'm getting at, I'm not sure they're going to be able to pass the audit or get a clean audit at the end of Q4 this year. So through 2023, they're going to have to be able to basically prove that they think they can repay $2.2 billion. And this is just ship payments that are backed because they don't really advertise it, but they deferred $1.7 billion of ship payments through COVID. So everyone's preaching the story, hey, we got through COVID, we're back up to speed. Well, they got through COVID taking on $10 billion of debt and not paying a single payment on a ship other than...
Okay, so Blake, could you just let's wind it up to a question here because
I'm sorry. Okay, $2.2 billion in ship payments is what's due through 23. $5.1 billion they have to refinance on their debt maturities at high yield. So just wanted to see how you guys see that.
Yeah, so I don't know that anyone on the stage wants to speak specifically to Royal Caribbean. I mean, I could imagine that if someone like Porter had a position, he wouldn't want to talk about it, but I think it's a fair question. It's a perfect example of what Marc Cohodes was talking about before, about these companies that are existing only because of cheap debt. So I don't know if Marc or Porter or Vincent, any of you want to speak generically about this type of situation, or if you want to speak specifically. I mean, I can appreciate if Marc, you may be willing to talk about it directly.
I have a quick thought. This is Porter. I have a quick thought, just in terms of if you look at some of these balance sheets, like Royal Caribbean, like American Airlines, they're complete disasters. And you talk about AMC and GameStop. I'll give GameStop a little bit of credit. They raised equity, but with some of these other guys that didn't raise equity and still have all this debt outstanding, they're dead. These companies are completely dead, and they better hope that that the credit markets open up again, and they will. But I just don't see how that a Royal Caribbean or American Airlines grows out of this debt. These companies exist for the bondholders now.
100%, Porter. 100%. The problem is, unlike Marc or yourself or KFAB or Vincent, folks up on and most of the Cantro people in this room, unfortunately, a lot of the investor class, they don't even think balance sheets are relevant, and it just. And then to the extent some of these stocks are even in indices, they got bought for reasons that have nothing to do with price discovery. So I couldn't agree with you more, and that just makes the opportunity set, I think, that much richer for someone like Marc or yourself or myself if you pay attention to the balance sheet. So
totally agree.
Yeah, 100%. All right, let's move on here. I want to go to Zach, and then Baseman is back. No, Zach, Connor, and then Baseman. Zach, what's up?
Hey, George, thanks. Question for Porter or Vincent. If you guys were to look back, I guess here we are today, comparing it to 07, 08 timeframe, and in 08, say September 14th being the eye of the storm, where would you put us to here at the end of July 2022, looking back in that time frame?
For me, I think it's different, right? And in that at that point in time, we didn't really know the powers. Like people talk about bubbles. To me, there's one bubble, right? And the bubble is central banks, money creation, and the like. That was the same bubble that was there in 2008. The only difference was that bubble manifested itself in housing and really weak bank balance sheets. Getting back to what George was saying, I think because it's now a bubble where now the bubble is sovereign debt because of central banks, This is going to take a long time. So anyone who's expecting the V, I don't see it, at least not now, at least not yet, and not at 4,000. So I just think this is, like George says, I don't think this is going to be quickly over and done. I think we're going to have to deal with years of managing through what we did for the past 13 years, my opinion.
Thanks for that, Zach. Appreciate it. KFAB, you step back and you got a quickie, KFAB?
Yeah, well, I just wanted to address what Zach's question was. I think I agree with Vincent relative to the sovereign backdrop, but outside of playing currency markets, that can be a bit abstract for a lot of people. I think a byproduct of that, and you've talked about, George, is the 40 years of financialization, and I think a direct byproduct of that has been really the bubble in Western consumerism. And I think an easy way to kind of see that, just look at monthly charts of Visa and MasterCard, Amex. Look at those relative to what's going on with consumer sentiment in the West. And the fact that this is all happening with, we're just at the very front end of a potential synchronized global recession. And as I've just said on some of your prior spaces, George, this is like a mutant, bizarro world version of 1980 to 82. The last time we had a synchronized global recession, that one kind of culminated a decade plus of inflation, and this one's kind of kicking it off. And I think that's what we're probably looking at, is the beginning of the end of the Western consumer bubble off cheap money and kind of perpetual pull forward of demand via central bank stimulus. And again, look at look at MasterCard, look at Visa. They look like they're beginning to be parabolas that have broken and rolling over. And think about that within the context of where consumer sentiment's at.
I couldn't agree with you more, KFAB. We're in a brave new world, and I think the next couple of decades are not going to look anything like the last couple of decades.
I'll actually add one more point. It's not only the end of cheap money, it's end of cheap energy, right? Which I don't think the world appreciates enough, is that the end of cheap energy is here. And look at Europe. It's a complete and total wasteland right now. I just don't even know how they get out of it. And we're doing, and this is touched upon what Vinny and I wrote in our semi-annual review. We're doing nothing to fix it. We're not. There's no capex going into energy. George talked about this. There's no capex anywhere, and the reluctance to do nuclear is just, it baffles my mind. That's the only way out, and they're doing nothing. And we've got this bill, this inflation bill. We're doing more to renewables. We're doing the wrong thing, at least in the short term.
100%, Porter.
Crazy.
100%. Couldn't agree more. Let's keep it going here. Let's keep the pace up. I want to go to what we got here. We go Connor and then Enfant. Connor.
Hi, George. Can you hear me? Okay.
We got you.
Great. Yeah. No. Thanks for hosting another excellent Spaces discussion. So my question really is for Porter and Vincent. Basically, I suppose, given their own involvement in what was one of the great credit trades of the previous cycle, and I'm just wondering what they think about the current. Thinking about a lot recently, and just in simple terms, I mean, across, the triple B universe, a chunk of which is likely to be downgraded, junk bonds, leveraged loans, CLOs, and then European leveraged loans and high yield bonds as well. You've got about $5 trillion worth of debt across that whole complex, and that's not even including the direct lending space, and the BDCs, which is another several hundred billion. But if you think about the magnitude of that credit, risky credit that's outstanding, and you've got this confluence of factors now with margin contraction, cost inflation, and to Porter's point there a few moments ago about the end of cheap energy, I think input costs for a lot of industrial companies are going to be elevated for a long period of time. And then on top of that, obviously, you've got the higher interest rates, and you've got a big chunk of this debt that's covenant light, so there are no tripwires for when it actually does all go wrong. I'm just curious as to what they think. Do they see a big potential credit risk or trade across that whole yield space, or how do they think about that? Thanks.
I mean, the lending that's going on now. I mean, I'll say the good news first. The U.S. banking system is not doing the dumb loans.
Correct.
Not doing it. They can't. Right. that they're terrible investments anyway. They're wards of the state, but that's a different issue, right? But the amount of covenant light loans now is like 90%. I was going crazy in 07 when it was like 30, right? And so I think you're in inning one of this, and there hasn't been a bankruptcy yet.
And just to add on what Porter was saying, keep it simple. The way we're expressing, we agree with you, and the way we're expressing that point of view is by shorting various private equity stocks, which have been incredible publicly traded stocks. However, we think they're fat, and that's where we believe the risk lies. And that's what we're shorting.
Yeah, I saw somebody last weekend who's been in the midst of the CLO manufacturing garbage business for the last 10 years at a Japanese bank, and they're doing record business now. Like in the first half, they've been, the demand for this crap has been actually going up.
Yeah, K-Fab, what could possibly go wrong, right?
Yeah, and I think a lot of that seems to be the thinking around that seems to be this diversification factor, which again is the same mistake as 08. In times of stress, correlation is one, but that again, it's amazing that just seems to be forgotten.
Yeah, Connor, no, you're on it. Great question. Thanks for that.
As a plug for Connor, he's got a great sort of blog that you do about some stocks. So I've read it a couple of times. Very well done.
Thanks very much, Porter. Appreciate that. You're very kind.
That's awesome. Let's keep it going here.
Thanks, George.
Thanks for the contribution. Always welcome here. Let's keep it going because I don't want this room to go on too much longer. Let's do Enfant and then Neely, and then Baseman's going to follow up. Enfant?
Thank you, George. I actually have a question for Porter. You just mentioned it's one of the greatest time maybe for stock pickers. But if you look at broader market and look at most investors' cash levels all-time high, and then gross and net exposure all-time low. Where do you see the disconnect between your perspective and broader market? And can you maybe illustrate some examples of where do you see the most attractive opportunity sets in the market to deploy capital as of now on both long and short side? Thank you.
Porter, you want to take that? You want me to take that?
You can take a swing at it. I'll follow up if you want.
Yeah, I'll take a swing, a bunt at it, and you'll probably give a more thoughtful answer. So I think when you look at performance data, whether it's for long only money, it's unbelievable, or for hedge funds, even more unbelievable. I mean, here it is. Was said earlier in the room by Danny that we're looking at perhaps the greatest opportunity for stock picking that we're going to see in our lifetimes. And that's epitomized by some of the numbers that Marc was talking about, how Porter's been doing and Henry's been doing. And these are guys that are doing the work, and they're looking at absolute value. It's mind-boggling to me that the average long and short hedge fund, as of like a week ago, was down like something 13% for the year. This is like your wildest wet dream come true. You couldn't ask for a better setup. And it's kind of why I'm getting back in the game, all right? But yet, these knuckleheads, as a group, hedge funds are down 13%. Because they're basically long-only guys in drag. And they don't know how to short. And they should take lessons from Cohodes. You wait for the jaguar to fall out of the tree. They're doing the lazy shorts, the stupid stuff. And they don't think they're brain dead on the long side. It's all the Tiger Global, and all the Tiger Cubs, all the bullshit, the FANG stocks with a little bit of Kathy Woods thrown in. There are no real investors out there anymore. And the long-only guys, they're closet indexers. You've had technology had the run of the roost for so many years, properly defined. The great John Roque, he's made the alternative calculation. Technology is not 28% of the index. It's 45% of the index. Because you got stocks like Amazon, which are in consumer discretionary, and Netflix, which I think is in communications. And so what's happened is they've all been run over. They're all closet indexers. No one's doing any real work. Not no one, very few are. Porter is, Cohodes is, Vincent is, Danny is, I am. So, and it's really sad. the way again, Charlie Munger, please call your office. You show me the incentives, I'll show you the outcome. If there was a young would-be Peter Lynch coming into the business right now, it's just so discouraging. I mean, the business is not set up to grow, to encourage independent thinking. Porter and Cohodes and Vincent, these are in the minority. And so I think the money management industry, they got a lot of explaining to do. It's no wonder why money's piling out of active funds into ETFs. Again, this should be a goal. This should be an unbelievable year for both absolute returns and relative returns. But these guys are just going through the motions. So the fact that they're all bearish, well, the long-only crowd can't go short. And basically, we've been in the everything bear market. So, it's just been a question if you're going to be long something, what goes down, with the exception of energy, everything's gone down. But then you got, the institutional pressures of, ESG and you can't own energy and this, that, and everything else. So they blacklisted the one sector you can make money in. And then everything else, just a question of how fast does it go down. So it's no wonder that the long-only crowd has a lot of cash because it's like anything they own goes down. And on the hedge fund side, it's like guys just don't know how to short. So I don't know. I think it's an extraordinary opportunity for guys like Porter and Vincent and Marc. Porter, over to you. Porter, unmute yourself, please.
Sorry, yeah.
Go ahead.
Oh, hold on one second. So everyone tells me how bearish everyone is and no one's invested. I just don't I don't know. I talk to everybody and I'm on the board of a couple, investment committees. Like they haven't sold anything. They haven't sold a single thing. And you look at all these, Merrill Lynch, Morgan Stanley advisors, they haven't sold a thing. They're asking, a couple of my friends are bearish financial advisors and they have their clients in 50% cash. And he gets questions every day of like, we're going to miss out. We're going to miss out. We're going to miss out. We got to keep buying. So I don't know. I sort of ignore all those things. When stocks are oversold, you can tell when stocks are oversold, right? Whether it's deep RSIs or, stocks get cheap. I sort of ignore the surveys and all that kind of stuff. Everyone has their own way of doing it. I sort of ignore the noise and look at, if a stock I'm short goes down 50%, the stock got cut in half and my position's smaller, maybe I'll trim some. And if it gets to my price target, I'll trim some. But other than that,
100% Porter, 100%. All right, let's go to Neely and then Baseman. Neely, welcome. What's up?
Thanks, George. Thanks for the opportunity to ask Porter and Vincent this question. I'm a toddler when it comes to understanding about financials plumbing, but I've lately been contemplating around the implementation of CECL and how that might affect loan growth, counterparty risk, reported losses, particularly in the community bank sector, where they really don't have the resources to understand how to estimate the loan loss. Do you think about this? Is there something to this, or do you think it's much ado about nothing? Thank you.
This is Vinny. I spent a lot of time on CECL. I think that's why Porter's laughing. Think of it the way I think about it. Don't say think of it. The way I think about it, it's an accounting entry. And what they're simply doing is providing life of loan reserves against respective loans, right? Which all that's going to do is create volatility and expected volatility in forward earnings. So when things are bad, and it's a pro-cyclical type of method of accounting. So when things are bad, they're going to have to over-provision because life of reserves, or if they're originating too many loans, you're going to see a very volatile earnings stream. What I would do if I were you is think about the community banks or any other financial services company and now start looking at them the way we historically have looked at them, which is on a book value and add back the reserves. And my younger colleague, Ronnie, came up with this term, loss absorbing capital, which is really the equity capital that you have plus the reserves. I tend to like to buy banks when they're trading at, say, a 70% discount to book. And I tend to like to sell short banks when they're trading at, depending on the bank, obviously, some are better than others, better businesses, at, say, 2 times capital. And if you think about it from that perspective, and if you really take a wider lens as to how you should invest in these things, I think it'll make your life much easier if you give yourself a little bit of duration when you're thinking about it.
Thank you.
You're welcome.
That's great. All right, let's go back to Baseman. You got a key, Baseman? Baseman, please unmute yourself.
Yeah, hey, this is for Vinny and Porter, and maybe Cantro can weigh in on this too. Can you guys talk a little about, maybe shine a light on trading against algos and how that's maybe had to change your style, if you will? I mean, for example, yesterday when Powell spoke, and he used the words like neutral, I mean, the market ripped, and a lot of the stuff you just, it's head scratching. And so I'm just curious how that algos have maybe affected things.
Yeah. So hey, Cantro, maybe you could take that, and then Porter. Cantro.
Hey, I can you repeat it? When he jumped me up, I lost the.
Yeah, no. The question was how does the role of algos, how does that affect your thinking and how you approach the market?
How does the role of algos affect how we approach the market?
Yeah, just on a trading basis. Maybe it's more a Porter question. I don't know, but
we're not so short term, and while obviously there's manipulation from algos and passive indexing and stuff, we still continue to see factor performance follow the typical macro and market cycle. So I think maybe it's not day to day, week to week. You get a lot of tracking error there, but it's not something that I think has broken our framework or something we're concerned that's going to break our framework yet.
Again, this is just my opinion, but the factor models that used by Citadel and all these guys have completely bastardized the market, right? They're hedging out their beta, every 30 seconds. And they're adjusting their factor portfolios in a dark room behind the portfolio's manager's back. It's completely bastardized the market, and I'm sure they're trading against them. That's a whole different issue. But if you be in markets and you sell stock short for a living, you see how these stocks react on Fed Day and on certain things in the earnings press release. I mean, the company's gotten smarter, and they know what to say in earnings press releases. When they know they're going to puke a quarter, they announce a buyback or stuff like that. And so, listen, you just become attuned to the catchphrases and stuff like that. But again, I try to ignore the noise as much as possible and focus on the fundamentals and what the numbers are spitting out. What do the balance sheets look like? What are the earnings trajectories? And so I think that's the easiest way to ignore the noise and the algos and all that kind of stuff.
Thanks for that, Porter. Appreciate it. Cantro, I was going to kind of bring the room to a close. I know you wanted to say something earlier. Any other thoughts? I think maybe there were some earlier comments that were made that I know you wanted to speak, but you had to fall out. Anything else you'd like to say, Cantro?
No, I don't have to keep everyone here. Our story. We're trying to figure out how long the market's going to celebrate the idea that inflation's peaking, and how long bullish investors are going to ignore the fundamental deterioration we're seeing in our economy, and the basic tenets of the business cycle working their way out. I think the weakness we're seeing, and you hear from consumer companies, how the consumer is getting crushed. And you think about it, last year, the tightening in the macro economy all came from oil and gasoline prices. It wasn't interest rates. That's been really over the last, let's say, call it maybe the last 12 months. But, the oil and gas was much earlier. And this year, it's all been interest rates and lesser extent, oil and gas, especially as the years evolved. And so I think we're going to see, as a result of that, we are seeing a shift in leadership in the market. I think the biggest losers of the first 6 months are not going to be the biggest losers going forward. And I think it's all playing out.
Kendra, let me ask you this question. Kendra, let me ask you this question, because you've nailed this market cold, and I love your construct about if we're looking maybe the opposite of the 2020, 21, where, you know, first you had the valuation expansion, they had the earnings kick in. Now, conversely, you had the earnings fall, the valuation compressing, and then the earnings fall apart. So I know everyone wants to celebrate rates right here, right now, but to my way of thinking, and to you just pouring gasoline on your fire, this doesn't say anything about the earnings outlook. And so if we're you know, if we still believe, and I certainly do, and I believe you do, the earnings are going to be really disappointing going forward for the next, you know, few quarters, and there isn't a bottom in sight until maybe the middle of next year. I mean, how long can people look past? I mean, how long can people look past the deteriorating earnings situation? And part two of that would be, what's actually happened to revisions in the last couple of weeks, few weeks? Are earnings estimates finally starting to roll over?
They're horrible. They're sitting at 20% month to date, and the S&P have been positive, which is the lowest we've seen in, you know, since COVID collapsed. And the overall earnings number, which got as high as 251 for next year, is now down to 247. We think that's just going to keep bleeding lower and lower and lower. And again, we're only in the second inning of this. And, you know, what really, to steal a Family Guy reference, what really grinds my gears is, you know, how investors think, oh, everything's priced in, we're all forward looking. But what the hell happened a year and a half ago in 2021 when we had a 30% rise in earnings because the earnings estimates were way too low, and no one could see that? Yet
Cantor, I think we lost you. You still there? Go on, keep going.
Yeah,
Go ahead.
It's just mind-boggling, the asymmetry of sentiment for investors, that we can see the future when things are going down, but clearly there's been no period in time where the markets can see the future when everything's going up. That's why it just keeps grinding up as long as leading economic rates are going up, and now they're all going down.
Well, Cantor, what if we get a scenario? Not what if we get. How likely do you think it is? Let's put it that way. How likely do you think it is? This is the belief I'm coming around to. How likely is a scenario that we get where, okay, we get a slowdown, recession, whatever, but the key thing, and I know this lives out in the future, so it's hard to prove this to anybody, but as was espoused earlier here this morning before you came in the room, this idea from the Fed guy and others that, you know, because there isn't as much excess labor around, companies are going to be hesitant and slow to shed labor. And if you get an environment where, you know, we've had accelerating wage gains, and Jim Bianco's pointed out that the disparity between salary increases for those leaving their job versus those staying at their job. I think the overall wage gain is like 4.7% or something like that, but those leaving their jobs are getting 6.4, and that's like an all-time record high, that disparity. So that's showing that there's no pressure coming on. You can say whatever you want about the bond market, but, you know, looking at unit labor costs, looking at labor, which is always, you know, one of the key, if not the largest component of profit margins or input costs, that there's no good news there. And so that if we get a slowdown, and let's assume pricing power dissipates even a little bit, if you want to believe the inflation is peaking story, but yet wage costs are, you know, not coming off, you could get not just a profit squeeze, but something that could last for quite a long time. And so, you know, rather than argue about it's a recession, it's not recession, inflation's, you know, is peak this month, next month, whatever, it's more the duration of this thing. And then on the last, so two-pole question. One, that, and then two, for everyone hanging their hat on future rate expectations, as Jim Bianco was pointing out this morning, that's just the market. If you look at the bond market has done a horrible job of forecasting interest rates looking out to the future. So I get it. That's the narrative du jour, but we should take that to the bank. If you look at the track record of what the bond market predicted, you'd be like, no way. So to me, it just doesn't make any sense. I don't know what part of that you want to respond to. There's two questions there.
Well, yeah, I think what's being underappreciated is, again, the duration of this, and everyone's gonna, you know, you're gonna see all this crap out of Wall Street, like this is what the market does when you go into recession and it bounces, it bottoms this many months before, or you know, junk like that. And you know, again, context is so important. There's only 7 or 8 recessions in the last 50, 60 years, so it's not a lot of evidence and data points. But I think it's screwing people up on the timing of this and the disconnect between the market and the economy and the sequence in the economy and the cycle, is that the first 4 months of this year's bear market was not an earnings bear market or an economic bear market. It was a rates bear market, which we haven't had in 45, 50 years. But that's when everyone started the clock on looking for weakness in the economy and keep saying, well, why isn't it showing up? Why isn't it showing up? Because we're only now beginning the earnings and employment bear market, which is just starting. So on your point about employment, every leading indicator that has any reliability at forecasting claims is pointing straight up, things that lead by 12, 18 months. And so what we're looking at today is 20 other series that look exactly like claims and behave exactly like claims to see, well, what are those doing? So things like, the most egregious one is consumer confidence, which is just completely blown up over the last year. Doesn't mean claims are going to shoot up tomorrow, but that's a red flag. We got ISM services employment, which never gives a false signal. That's at 47 today. That's the third worst number in the history of that data going back to 98. You got average work week at a new cycle low. So there's enough evidence that this is all happening if you look deep enough, and that's what's going to help us time. Still a little bit too early. I think another quarter and everyone's going to be watching claims like they're watching inflation.
Can I say something, George?
Go for it, Mark. Mark, go for it.
I don't know this Cantro fellow, but he sounds pretty sharp.
And Mark, I got to stop you for 1 second. He is the best strategist on the street, period. You got to get to know him. Keep going.
I get that, but I don't want you to be frustrated because I think there's two things that everyone's missing. One is the effect of Cartoon Network on people's minds, which completely ruined people's minds, and that this cycle is very different because the leverage and the debt is so extreme. So Cartoon wants you to think that the Fed's pivoting and the worst is in and it's time to buy. Everyone is trying to jump the gun to Porter's comment because everyone focuses on things by the minute. People who do their work know it's too early, but you have a whole group of investors, including institutions, who don't want to miss anything. And everyone thinks that now that the Fed is so-called done, that you have to own things. Well, no one knows if the Fed's done. And two, you don't have to own things unless you specifically like it. And I don't want to be too crude here, but as my late friend Bruton Smith would say, once the dog catches the bus, if it can't eat it or fuck it, what does it do? And I think that's going to be the problem here because inflation is not going back to 2%. Earnings are going to suck, and the Fed's in a box. So if you think you can make money in stocks, you better have something that's very, very idiosyncratic, very specialized, and that you've done your work on it. Other than that, you can just absolutely get destroyed because all of the atmospherics try to push you now the right way. So Cantro, don't be frustrated by it. It's just a function of what's out there that everyone wants to jump the gun and just stay disciplined with the work you do. Because, from what I hear from you, I think you're a sharp guy and you'll get it right. But just don't let all this noise get to you. That's kind of my point.
Wow.
No, I do, and I appreciate that. And that's why we spend every day, every week trying to come up with more material to check ourselves, debate our own views, and to try to best communicate our views of where we think things are headed. And, the more evidence, the better. We're big on breadth of information. That's why, that's where the confidence comes from today, is just having a framework and seeing the breadth of the story. And listen, if I'm wrong, I got to take a year off because this is as much as I've seen the stars line up. But again, it takes time.
Well, George, I've said this to you before, and Mike, I think you might have been on the call before. If you go back to literally this time in 2008, we had just gotten a 1.9% GD print. The market was in the midst of a 10% rally from the July trough to the August peak, in the midst of Fannie and Freddie are basically going bankrupt, in the process of going bankrupt, right? So these kind of moves are absolutely to be expected within the context of a normal cycle turning over.
Yeah. KFAB, as always, you nail it. Guys, just think about this room for a second. Just look at this room. To start off with Danny Moses, but look what we got going up here. We got Cohodes, Cantro, Porter, Connor, Vincent, KFAB, Neely. Moses has already left. I've left out some other people. It's just, I don't know how much money I would have paid back in the day to listen to a panel discussion at a fancy conference. This is unbelievable. I mean, I keep saying we got the best spaces, the best rooms. We certainly do. And the main reason is we got the best speakers and the smartest audience. I want to thank each and every one of you. This is just phenomenal. So with that, again, like my colleagues tell me I talk too much. These rooms go on for too long, but can't keep a good thing down. We're at 2.5 hours. We're going to call it here. Well, don't worry, there'll be more coming in the coming days and weeks. It's been a fabulous room. I want to thank again Cohodes. It's always phenomenal when you're here. Porter, I'm glad you're often here, but you don't talk that much. We got to get you up here. In fact, we're going to do a room, I think, just with you. We'll have Cohodes ask the questions. But this has been awesome. And we're going to do it again. So I want to thank everyone. This has been phenomenal. And see you before too long. Everyone take care. Bye-bye.